We're live.
Okay, thank you. I'd like to call this session of the Board of Revision to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. Panel members with me today are Lori Davidson and Narendra Danjal, and my name is Mark Boreski. I will be chairing. From the assessment department today, we have Merrick Froelich and Jeremy Powell, and our administrative personnel today is Sally Caulfield. To the Zoom participants of the hearing, please note you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board of Revision YouTube channel for the hearing process. Once the host admits you into the hearing, please close your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. And here's where I have a small problem with SharePoint because it will not let me scroll down any farther in the introduction. Let's see if I can fix that. Sally, could you resend the SharePoint link to me, please?
Sure.
Are you sending it to me in an email?
I am.
There it is. Getting an access denied message.
Oh boy. Do you want to go into recess for a moment?
Yes, we might as well.
We're back.
All right, I will pick up from where I left off in the introduction. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have. Sorry, a box appeared on my computer here. Office online frame, whatever that is. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You'll receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1 to 6 and 8 and 9 on our docket today. And Ms. Caulfield, could you please confirm the assessor's and the applicant's testimony, and then we will begin.
Please state your full name.
Jeremy Reinbold.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Please state your full name.
Marcelo Navarro.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
We will then begin with the first item on our docket today, which is the property address 36 Roslyn Road. Mr. Assessor, when you are ready, could you begin?
The file number is 222473. The roll number is 120324840000. 37 Roslyn Road. The assessed values for 2023 is $1,129,000. Just before we get forward, before we continue forward, I'm not the assessor who was handling this file. Mr. Frolik was, and he wasn't able to attend today. So I'm presenting on his behalf. So this is his assessed value. He has a recommendation to reduce it to $1,079,000. That's what I'm presenting today. From my understanding, not being in the loop between agent and assessor, that this building is going to be torn down before January 1st, 2023. So we could make this appeal, I don't want to say mute, but physical building no longer there, January 1st, then the value put to it, there'll be a having a matter of this appeal. So with that, I had some conversation with Mr. Noranda that it'll be have to be confirmed. So from that point, I think it should just be confirmed, given that it's going to be torn down.
Okay. So you would then otherwise not be presenting any evidence on it. And Mr. Navarro, is that the case for you as well?
That is correct. I would like to make a correction there.
Sorry, go ahead. I'm out of the loop between agent and assessor, so I'm just kind of sitting in today for the other assessors. So.
Yeah. So the property hasn't been demolished yet. We are waiting for that permit for the demolition. However, it became uninhabitable some time ago. So we assume that the supplementary will still take it back beyond 2023.
All right. And otherwise, you won't be presenting any evidence on it. Is that correct?
We will not. We will ask for a confirmation.
All right. Thank you very much. In that case, we can move on to our second item on the docket.
Okay.
Which is which is 400 Ellis Avenue. Give us a moment to bring that up.
Mr. Chair, would you like me to affirm the applicant?
Oh, we have a new one. Sorry, didn't realize
Yes.
that.
Nope,
Yes,
no
please.
problem.
Yes, please.
Mr. Applicant, please state your full name.
Rod Slaughter.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Mr. Assessor, when you are ready.
File number is 22-2086. Roll number is 1305-237-1500. Civic address is 400 Ellis Avenue. The 2023 assessed value is for $15,035,000. The effective year built in the property is 1992. It's newer-ish downtown OB. So the leasable area is 91,782 square feet. Originally built for IBM. If we turn to the next page, it's just a synopsis of what it is from Shelter Canadian's property portfolio. As you can see, it sits in the corner of Ellis, and there's a back lane that leads to Portage Place. So you look on, starting on page 5, this is from Architectural Group's interior photo of the second floor that was renovated. As you can see, it's quite nice space, finished well. We move along, starting on page 9 are some interior photos of the property that we had on file. I've yet to be in this property. There was some vacancy after IBM left, and obviously redevelopment of the second floor. But these are photos that were taken before that. So starting on page 9 is the entry area. And on page 11 is some of the shell space on the third floor that's vacant at that time. After that, on page 12 is some of the permit work that was developed, obviously with the second floor. You can see the interior alteration permits that were associated with that. And after IBM left, I believe they had a residual amount of space left in the building, but they were marking section on page 17. We have a 2017 listing. They're asking $16 net rent to get in the building. As you can see for the write-up, these are the layout of the floor that they're offering. There is another listing on page 21 at $20.50 net rent. As you can see, it's higher than market. I believe that was associated with there's a data service area capable of having that. So you're going to get naturally a bit of a higher rent for that. So so as we go along, again, just general listing. From that, if we skip ahead to page 31, is the INE of the building, or I should say the INE for the building. Simcor's in there, as well as the province and Veterans Affairs. And you can see it's semi-gross for 2 hoodies and 1 is net. One's at $19.95 net, and then 16.25 semi-gross and 13.94 semi-gross. So right now, there's about a 5% vacancy within the building. And this is one of the properties that didn't make it into my OP study, which we'll be referencing shortly, simply because the nature of the semi-gross leases and the $19.95 rent stuck out so much that it was obviously an outlier for an OP. And given the fact that it's more related to data service, the data service center, that nature wouldn't be reflective of the typical OP marketplace. So this property never made it into the OP study that I'll be presenting shortly. So From that, we can pivot to the OFB study for the rents and the vacancy and the non-recovables. And I tried to explain the OFB and OFB studies, which we'll get to today. I understand the chair has heard both studies, but the other two panel members may not have. I'm going to try and do it a little bit differently. So I want to highlight on exactly how it is. This is a study that was based on 6-year study leading up to the reference date.
Sorry, are we turning to the study now as opposed to
Yes.
this brief?
Yes, sorry, maybe I went too quickly there. Yes, please turn to the OFB study.
All right, just a minute, please.
So I have a 2-page commentary which you can read. I'm not going to go through every single summation point in it. But basically what we've done here is we looked at a 6-year study.
Sorry, but what is it? How is it entitled on the docket?
I'm not sure how you had the title. It's the supplementary OP study that was for the OP property.
So, Sally, where is it?
It is called,
It's right after the document we just had open. Like the assessor's submission.
A&T study.
Okay, so I can go through it point for commentary point if you want, but generally what we looked at was a 6-year study of the marketplace, and we're taking the rents that are in place in that year, the expenses that are in place in that year, the shortfall, vacancy, and any lease ups that occurred or any catching any step ups which occurred to be reflective of the rents that are in place. Linear to that year, isolated that year, I should say, and then you move forward and each year doing it for the 6 years. So what I did was not only do it for each individual year, but I stabilized the last 3. And the last 3 years is what I'm using to justify the rents and the vacancies that are in place, simply because these are high investment profile properties. Typically, we used to bring in 1 year, the latest year to the reference date. I felt that wasn't enough, and an investment purchaser, since we can't look on a go-forward basis and we're confined to looking at up to the reference date, we need at least 3 years to look at the property. So I'm giving a 6-year look, as well as the last 3 years stabilized for the marketplace. So having said that, I'm going to do it a little differently, like I was stating. On page 4, there is a chart, and then below it, there's a graph. This is pretty much all you need to know about the complete marketplace on that chart and on that graph. What I'm trying to illustrate on the graph is, if you are an average property, you should be right at the median average. If you are an above average property, you should be to the right side of it. If you're a below average property, you should be to the left side of it. So when you have a better performing property within one standard deviation, you should be approaching the positive side of the right side of the graph. And that's really all it as simply as put as I can put it. If you're an average, you're the mean average. If you're below average, it's underperforming, you're going to be below that. And if you're above that, you're going to be on the other side. So this property here would be a greater than average property, as you can see from the renovation, you see from the rent that I've been asking for. So you would expect that they would fall between the first bracket for the positive side of the standard for standard deviation towards the second. And you can see how they're listing at $16 triple net. And of course, with the data service center that they have, it's a little higher than that, advertising at $20.50. So our average study for weighted average was for 2020, $14.84. For stabilized for those 3 years was $14.39. So that would be average. You would be expecting this property to be somewhat greater than that. So, and given how they're advertising it, that's where it fell in the marketplace. So that's what they're expecting. So from that, the exact same rationale is applied to the vacancies. As you can see, the marketplace was was 13.3% for 2020, and stabilized for 3 years, it was 12% for weighted average. You see the number of CRUs that we're using, the number of lease ups or the step ups that were reflected in those years was 217. So that's for the 3 years, for 2018 to 2020. And of course, we looked at greater than that, but we're relying on the last 3 years. And then the shortfall was $14.09 for the 2020, and the average stabilized was $13.88. And then the non-recoverables weighted average was 4% for 2020, and averaged out over 3 years, it was 3% for the weighted average. So, and again, our non-recoverables don't include any tenant inducements of any kind, free rent, leasing commissions, any things of that nature we exclude out. The agent positions as they bring that in, that would alter the number a little bit higher. But we're going to the case law that indicates that we're to do that. So from that, I can move on to back to the workup that we have from this for this property on page 27. So on page 27, we have 91,782 square feet. The average is just a bit below $14.33. So the model took it as an average B. As we can see from the second floor, that's not average. That's significantly greater than average, at least on that floor. The third floor, I'm unsure whether the shell has been shelled or what the condition is. And then again, on the data service side, it was $20.50, which we're not going to be close above. So overall for the building, I think $14.33 is probably a bit on the conservative end, but I'm not going to be seeking an increase in rent for that. Our vacancy is at 11%. Which produces the potential rent with the $14.33 is $1,315,935. Our vacancy at 11% is an effective gross income of $1,171,182. Our expenses, and again at 3% for non-recoverable and shortfall at $12, is a net operating income of $1,014,895, and we cap that at 6.75 cap. So that gives the $15,035,000. And with that, I think it's pretty well defined based on the study and the advertising of the building and the condition that we have at this moment in time. So with that, I'm okay.
Mr. Slaughter, do you have questions?
Thank you, Mr. Chairman. Mr. Pohl, you mentioned, first question, did you have a chance to inspect this property?
No, I stated I haven't been in this property yet.
Okay. So you're aware that the land to building ratio here is almost 1-to-1. There isn't underground parking. There is no parking associated or owned by the owners of this property. Is that correct?
Yes, I'm aware of that.
Okay. You mentioned in your presentation that after IBM had vacated or significantly downsized to about 15% of the area in 2013, you mentioned there was some vacancy. Just to be clear, that some vacancy was 85% through 2013, 14, 15, 16, and hovered above 50% up until about 2020. Is that correct?
Yeah, they lost their anchor tenant, and then the building had to be, as you can see on the second floor, it was refitted. So.
Yeah, and that was after considerable years and years of being marketed. Is that correct?
Yeah. Yes.
So is that significant vacancy common in your experience for a Class B building?
When an anchor tenant leaves, it takes a while to fill that hole. In this case here, it was a moderate to longer time, but I mean, as you can see for the advertising, they were advertising it. They were also advertising it at $20.50 rent for what I assume would be the data service element of the building. So
that's correct.
That's a bit more of a unique. I shouldn't say unique, but it's a bit more of a select tenancy that you would need.
So the significant vacancy and the extended vacancy does not speak to you about perhaps the location not being ideal for office tenancy? You
have parking, ample parking, just south of the property. You're connected to the skywalk. You have a property in the condition, as you can see, when it was tenanted, and they didn't put much into the second floor other than a typical tenant fit up. But again, very nicely done in the floor plate of the of the building speaks to what could be there. So if you're looking for a long-term tenancy, you're going to be requiring a little bit different selective of the marketplace. So in this case, here they're able to retain the tenant they did on the second floor, and you can see the space that was renovated in. And if we looked at that for the rest of the building, if it was in that condition, it would be quite a marketable building.
On page 12, you list some of the permits that went into attaining these tenants. And to be clear, those permits that are shown dating back to 2013, but the majority between 2016 and 2019, they are paid by the landlord and they are not paid by the tenant. Is that correct?
I couldn't tell you who paid for them. I didn't put the leases in place or the contract in place that led to that.
Okay. And only two of these permits, about $620,000, relatively small amount, has occurred since the last assessment cycle. Is that correct?
I believe so, yeah.
Yeah, and yet the assessment has nearly doubled, 100% increase.
I'm just looking at on an individual assessment for what's there for the marketplace. We've done a significant study on the OFB marketplace and combined with the OFB marketplace to be reflective of what the market is.
That's all the questions. Thank you, Mr. Chairman.
Ms. Davidson, questions?
Yes, I just had one question on the cap rate. Looking at your cap rate table on page 29, is this considered, just for my information, is this a downtown B building?
Yeah. Yeah, sorry. 20.
Okay, thank you.
Page 29.
Yeah, that's okay. I can see it. Downtown B, right?
Yeah.
Thank you. That's all my questions. Thank you.
Mr. Danjal?
So just to clarify, the overall capitalization rate at 6.75 was calculated from the OFB marketplace study.
Yeah.
Is that correct?
No, not from the marketplace study. That was based on modeling.
Modeling?
My own independent study from anything with from the OFA and OFBs, and we're using it at appeal here today. But that's limited to rent, vacancy, shortfall, and non-recoverables, and not cap rate.
Okay. That's the only question I had. Thank you.
Okay, thank you. Looking at the premise IDs and then the leasable areas, there's the 22,000 plus 8,000. Which floor is that?
Bear with me here while I catch up to you. Well, it would be 22,000 and 8,000 would be the main floor, and then the other two floors would be the second and third floor.
I see. Okay. And is that because there are two tenants on the main floor?
I believe so. I believe there's one space that's still vacant, and I think the agent would be able to speak better to that. I'm not sure. I haven't been in the building. So,
Okay.
other than what's shown on the rental.
And the difference in the rent per square foot, is that just attributable to size factor?
Yeah, the model would have taken that into account for a bit of a difference in there. That's why you see the 30,000 some odd square feet set around 1450, and then 22 is still at 1443. So it's a bit of a piece of scale being applied there.
Okay. All right. That's all my questions. Mr. Slaughter, your evidence, please.
Mr. Chairman, I do have a follow-up question following one of the panel members' questions, if you don't mind.
Certainly.
Thank you. Thank you. Mr. Pohl, just back to the question asked by the panel about the capitalization rate. Just to confirm, page 29 of your evidence is the only evidence that you have today for the capitalization rate. Is that correct?
Correct.
That's a summary of broker opinions from marketing brochures,
Exactly.
ranging for Class B from 6.5 to 7%.
Correct.
And would you agree that location is a major factor when we're looking at the rate of return or the capitalization rate expected by an investor?
Location is a big factor, but there's multiple factors that go into it. So
Fair enough. Thank you. That's all the questions.
Okay. So then your evidence, please.
Thank you, Mr. Chairman. Right off the top, I'd like to, I submitted something yesterday with rebuttal, and it is a recalculation of the value that we'd like to request, and slightly higher than what I have in evidence. I just want to make sure the board has that.
All right. So where do we find that?
I have to distribute it,
Okay,
so just give me a moment, please.
He distributed a one pager yesterday.
That's it then.
That's
Okay.
13,000,900.
That's not the rebuttal then. Okay.
Yeah, it should be Ellis 400 revised valuation with city rent.
So you have it?
No, I don't have the rebuttal. I just have the one pager with the adjusted assessment.
There would be no rebuttal for this property. It's just the one document pertaining to this assessment would just be the valuation revision.
And we do have it.
I can see it, right?
so we need both this document, the one pager, and your main brief.
Yes,
Is that
please,
correct?
Mr. Chairman. Yeah, if you just have the other document on the side, I'll speak now to the main brief.
All right.
Thank you. So to summarize, what I have done is in reviewing the city's evidence, I realized that we're not too far apart on the market rent. And we did have a discrepancy in leasable area, but having inspected the property, I can see how there might be some discrepancy on that issue. So I thought it'd be best, because otherwise that opens up a whole bunch of discussion that would take some time, to focus on really the two primary issues that I have in contention. And those are the capitalization rate and the non-recovered expense allowance. So to be clear, we are accepting the city's market rents, which are close to our analysis of actual. I'd like now, Mr. Chairman, to talk a bit about the property. I had a chance to inspect the property again. I've been through a number of times, but again on January 6th of this year. On page 6 and 7 and 8 are photographs of the property, and I'll just walk the panel through the property now. So it is located at the intersection of Ellis and Kennedy Street. It's just north of Portage Place. It was originally built in 1992, and it's a 3-story building. The plan area is approximately 32,000 feet, and the gross area is just about 95,000 square feet. IBM, it was originally built for IBM, and IBM occupied the building, most of the space until 2007, and then they downsized to only a portion of the main floor. So from 2013 on, we had a vacancy in this property of 85%. It was actively being marketed the whole time, and there was very little interest in the property. One of the concerns was it's not an ideal location. This location has various issues that I won't go too far into, but there's a lot of vacancies around this property. Now, the main floor of this property, the predominant part of the main floor, and you can see this on page page 7, kind of. You see the lobby on page 7 as you come in. And as you move to the right, which would be heading west, you move into what was the data center for IBM. So this is a little bit different than a typical office. It has raised flooring and it has a high data conduit capability. And this space was not desired. The demand was not high for it, nor was the second or third floor for that matter, but they did lease later on. I'll get to that in a moment. Now that's to the west. To the east is, you see this kind of rotunda area in the exterior photo. And I have a picture on the bottom of page 7 of that space. It's been vacant the whole time. There's no interest in this space. And the reason I say there's a bit of discrepancy on the leasable area is this space kind of moves along the eastern side and gets into the mechanical areas, which there's a question of whether or not they could have as part of a tenancy. So that's why I figured it's the difference in 2,000 square feet, I don't think is major. And then on page 8, we see the other 2 floors. The second floor is occupied by the province since 2017. And the third floor is occupied by the federal government since 2019. The western portion of the main floor was finally occupied in 2020 by a company called Simcor. They came over from 195 Fort Street, and they had need for the data capability. In each of these cases, Mr. Chairman, first of all, again, the demand for these spaces was not high. They had sat on the market for years. When these tenants finally expressed interest, the landlord had to do considerable work. And there's been a lot of discussion about this concept over the last number of hearings. And I'd like to reiterate something. And Mr. Chairman, you asked a great question at a hearing about a month ago. When we talk about tenant improvements, that does not necessarily mean the work is done by the tenant. It's the improvements done for a tenant. In some cases, the tenant may do that work. In a market like we have today in downtown office in downtown Winnipeg, and when I say today, I mean April 1st, 2021, we are in, for about 3 years now, what's called a tenant's market. The reason for that, and I've mentioned this before, is that supply has increased, especially with True North coming on stream or on market in 2018, and demand has remained basically static. In fact, net new demand in downtown office is very, very rare. What you find instead is tenants moving from one building to the other based on enticements by landlords. The bargaining power is squarely in the hands of the tenant. And what this means is that tenant or owners are more susceptible to losing tenancies at the end of lease terms. And they have to spend more and more of their own money to entice tenants into the building. And this is the case universally, across downtown Winnipeg. It is especially the case in the subject property. In order to entice the province into the second floor, that was the first tenant to come into this predominantly vacant building. The permit cost that the assessor has in evidence on page 12 of their evidence was, I believe, $1.2 million. That's what they had to spend, the owner. Similarly, when the federal government took the third floor, they had to spend almost $2 million for the requirements. Provincial and federal tenants come with a long list of requirements for space that the landlords have to meet. And when Simcor came in, they had to spend about $1 million in total. And what that basically was is, when I talked to them in inspection, I thought it was interesting. The raised floor underneath, they have to completely secure. They can't have any risk of anybody somehow getting into that from the outside. And then there was some other, fitting up the space. And this is another thing that is very important for our discussion on valuation of property when we're talking about tenant improvements. Oftentimes, most times, when a tenant has to refit a space, it's based on their specific requirements. And those requirements are not necessarily going to be the requirements of the next tenant 5 or 10 years down the road. And that's why you often see these spaces gutted by the landlords. They don't care about what the last tenant had put in. So it has to be very clear the amount of money that it takes for a landlord to bring these tenants in, especially in the subject case. We are not asking for this panel to deduct the costs that the landlord invested from the rents that they're attaining to come down to what would be called a net effective rent. The municipal board has been quite clear that that is not appropriate. But what I am suggesting is that the panel must be aware that these are real costs that are ongoing and increasing in this type of market and have to be recognized. Mr. Chairman, that leads me into the first point of contention, which is the non-recovered expense allowance, which is directly related to these kind of expenses I mentioned. Now, I have a separate document, non-recovered expense study, that I could go through for the panel, but I believe everyone on the panel has heard I'll just go through this. So I'll ask your advice, Mr. Chairman. Would you prefer me just to give a Coles Notes version or go through
Coles
this?
Notes, please. Just
Okay,
Coles
thank you.
Notes.
Okay. Historically, the City of Winnipeg Assessment Department had applied an allowance of 7% of the effective gross income of any property valued on an income approach to account for what we call non-recovered expenses. And these expenses are basically all of the expenses that a landlord incurs in the operation of their property over its economic life that they cannot recover in a typical lease from their tenants. So imagine two buckets of expenses. In one bucket, you have the expenses which the market typically allows you to recover in a net lease. That includes your taxes, your CAM charges, your utilities, your snow clearing, your garbage clearing, your repair and maintenance. And then there are those expenses that you cannot recover. And the majority of these expenses are going to be space marketing costs. Anytime you have a vacancy, you have to invest in leasing commissions, and you will inevitably have to invest in either landlord improvements or a tenant improvement allowance in order to secure a rent. Nowhere in the valuation are these expenses recognized except in this allowance. And the allowance is, and the reason it's called an allowance and not an expense deduction is, it's an amortized amount over the economic life of the property. So in any given year, you may find extremely high space marketing costs or non-recovered costs of other types. It could be professional fees. It could be any number of items. And in another year, you might find zero. But the point of the allowance is it takes these over the economic life of the property as an amortized deduction. Also included in this allowance is not just these, what I'll call non-recovered operating expenses, but there's a component for structural reserve. And historically, that was 2% of the total 7%. And so that reflects the capital improvements that will have to be invested in the property over its life. So these are the components that made up the 7%. And what happened in the last assessment cycle, of course, is the city had changed their mind and reduced that to 2%. We had argued that, I think, on every property. And for 2023, the city has increased it to 3%. But that is not consistent. Number one, these expenses are recognized in all valuation material. When you study the valuation of properties, it is mentioned as an expense that cannot be ignored. It is typically deducted by other assessing authorities and has been here historically in Manitoba. It's still deducted by the province, a provincial assessor. And we had done a study that I won't go into, but we had looked at all types of properties to find that, yes, over the life of a property, we will have kind of a seesaw of these expenses, very high sometimes when vacancies are high and relatively low in sustainable times. But they will happen over the life of the property. And we found that the 7% total, which included the structural reserve, was appropriate based on our study. So with the subject property, we can see that millions of dollars have been spent. And will again when any of these units become vacant. So over the life of the property, we certainly feel that in all cases, for all properties, regardless of where they are in the cycle of tenancy, deserve the allowance, and 7% should still be applied. That basically sums up the non-recovered expense argument, Mr. Chairman. And now I'd like to move over to the last piece of the valuation that we have in contention, is the cap rate. And again, Altus has done a separate study on capitalization rates for downtown office properties. Maybe in this case, I will ask the panel just to turn to that, and I'll just very quickly go through it, Mr. Chairman.
Okay, give us a moment.
Sure.
Okay, does everybody have that?
Yes.
Mr. Danjal? Mr. Danjal, do you have that?
Yes, I do have it.
Okay,
Sorry.
good. All right, carry on.
Okay, thanks, Mr. Chairman. So on page 2 and 3, we basically go through just some of the overall rationale. And I don't think I need to go through this with the panel. Everybody here knows exactly what the capitalization rate is and how it's determined. But there is an important point that I'd like to mention. When determining a capitalization rate, if you have the data, clean market sales that are applicable for review or admissible, you have to make sure that the methodology that you use in determining the net income is the same methodology used when you're valuing the property. That's a very important point. On page 5, we talked about what happened last cycle. Last cycle, remember, the reference date was April 18. This is pre-pandemic. And it was just the beginning of what I describe as the tenants market. It was just starting at that time. So I won't go into too much detail there. I'll actually ask the board to skip ahead to page 8. Because one of the first factors we have to recognize at April 21 is the world is different than it was in April 18. We're in the middle of the pandemic. And while the pandemic did not necessarily affect the rental income of office properties, because most of these leases were in place and would not be affected, it certainly affected main floor retail and services and parking incomes. But very quickly, and I've gone through this before, I won't spend much time. We had done a study, Altus as a whole, the entire company did a study of the top investors, owners, and brokers across the country to get their opinion in November 2020. What is happening to the office market? What is the perception to investors? And this is the key. This is exactly what a capitalization rate is reflecting. It's what does the market expect of the incomes that they see going forward into the future based on what they know today. And that study, Mr. Chairman, is summarized on page 10 and 11. And I'll just quickly point out, and 12, sorry. I'm going to go to the page 12. And the question asked in the study was, what are your expectations for capitalization rates in 2021? We did this study twice, in June 2020 and November 2020. And you can see in black the results for November 2020 on page 12. And the vast majority of these top people in Canadian real estate suggested, yes, based on what we're seeing, capitalization rates are going to increase in 2021. And why? Because it wasn't necessarily the pandemic, which one could argue was an event. It was that it started a revolution in how we use office space, and that's called the hybrid work model. The fact that most of us are on a screen right now is an example of the effect of that. And that inevitably raises concern with investors of office properties, because as tenancies come due, there is a very high likelihood that tenants will be thinking about the amount of space they require in this new world of hybrid work model, and they may downsize. We already have a supply-demand imbalance in downtown Winnipeg, and now we have the specter that could change and increase the risk going forward. For lower quality properties, for higher quality office properties, the majority of people thought that the decrease would be about 25 basis points, increase, to cap rate. And for lower quality, it would be closer to 50 basis points. Now, I'd like to ask the panel, please, to go ahead to page 15. The unfortunate thing about doing a capitalization rate study in the middle of a pandemic is that there isn't a lot of transactions or valid transactions that we can examine for an appropriate cap rate. And so we do turn to secondary sources. And like the city went, the only evidence the city had in place is the summary of the broker studies. Now, these are studies, they're marketing brochures, basically. So we're not exactly sure what the methodology is on how they determine the capitalization rates, but it gives us a general sense of what's happening in the market. On page 15, you can see for Class B, the cap rates in Q1 21 would range for Class B from 6 to 7%. But the interesting thing in the very last column, Mr. Chairman, is the increase in the basis points of the cap rates from the last cycle, Q1 18. The brokers all agree there has been an increase in capitalization rate. That is exactly what the investors were telling us in the studies in November 2020. There is increased risk. The world is not the same in April 21 as it was in April 18. So lastly, on page 16, we had 3 transactions that we looked at. And when we look at these transactions, Mr. Chairman, and this comes back to my very first point, we analyze the property in the same way that we would the subject property. And that is from a fee simple perspective, with the understanding that actual rents in place, unless there's a reason to not believe they are best indicator of market, are the best indicator of market. And of course, applying the allowances for vacancy, shortfall, and non-recovered expenses. So I have the workups in evidence in the appendix, but I'll just state now that in each of these cases, a market vacancy is applied, adjusted if the vacancy incurred in the property is in fact higher over a 3-year period. Market rents are applied, market shortfall adjusted if actual is higher. 7% non-recovered expenses. We then determine the NOI, and we, from that, determine what the sale price imputed as a capitalization rate. Two of the properties are suburban. 383 Dovercourt is the first, and 70 Portage is the third. The cap rates on those properties, though, are 7.23%, 6.97%, hovering around 7%. And the second property, 433 Main, I think is a very interesting property. It's one of the major transactions in downtown Winnipeg leading up to the pandemic. This is before the actual pandemic started. And we imputed a capitalization rate of 7.66% on that property. Another property that was on the market, I think, is very interesting because it speaks to what happens when you have a property designed specifically for a tenant and that tenant leaves. And the property isn't necessarily designed in a way that the overall market would value. And that comes up with 325 Broadway. This was a property that was occupied by CRA. It was designed and built for CRA. And when they vacated at the end of 2020, the property went on the market and was listed for sale at $11 million, which is just over $100 a foot. That was significantly less than what the actual rent capitalized imputed as a value. And by the reference date, the property sat still on the market, and I can say that there was very little interest in that property. So it was never even attained at the $11 million. And I think that's a very interesting connection to the subject property, because we have a property that is not in an ideal location, that when the tenant that the property was designed for vacated, it was very, very difficult for the owners to lease it again. And if I were a potential purchaser looking at this property, I would say, okay, great. We have 3 tenants in place. We still have a vacancy issue on the main floor. But looking forward into the future of this property, do I feel secure? And if I look at the history of how difficult it was to lease this property, and I look at what's happening in the market today, I would not feel secure. The conclusion of our capitalization rate study, Mr. Chairman, is that 6.75% was the established capitalization rate for Class B last cycle. We see that all agree, investors, brokers, everyone agrees for good reason. Risk has increased by April 21. So our baseline capitalization rate for Class B, this is on page 17, is 7%, 25 basis points increased from the 6.75. We then look at site-specific issues to see if we should make an adjustment to that. With the subject property, the only adjustments I would make, frankly, would be upwards. And the reasons are, there is no parking on site for the subject property. There's no underground parking. There's no parking controlled by the owner. The tenants demand parking. What the owner has to do is secure a set amount of stalls in the Portage Place Parkade for their tenants. And what happens is the tenants will say, we need whatever, 20 stalls, let's say, for this year. And they secure that deal. The tenant has the right to come back, though, and say, you know, we have half the people working in the office. We only need 10 stalls this year. The owner's on the hook for 20. And that was one of the first risks. When I talked about this property with the owners, one of the first things they mentioned was that risk. That's one. Number two, of course, is we have established that this property has difficulties. It's proven by the amount of time it's sat vacant. And it speaks to me about not only the lack of parking, but also the location itself, which is surrounded by vacancies. That also would cause unease from a potential purchaser's perspective about the sustainability of this income going forward. Mr. Chairman, I'd like now to go back to actually, if you could please turn to our revised summary page. That was the additional page that I submitted, because this now summarizes our new position. So it should be a one-page document with a blue chart, 400 LS 2023. And anything in blue is what we have in contention. Anything in black is what we agree with the city on. So our new position is that, yes, we had a difference in the rents originally, but we will accept the city's rent. We ask that the 7% non-recovered expense allowance be applied. And from the resulting net operating income, we ask that the 7% capitalization rate be applied. And the revised value then is $13,962,000. I believe that is all that That completes my presentation, Mr. Chairman. So thank you very much.
Thank you. Mr. Poole, do you have questions?
Yes, I do. Sorry, that was a bit of a lengthy presentation, so I'm gonna go to kind of the meat of the difference. The difference isn't so much in the rent now. But the difference is in the non-recoverables and the capitalization rate. Would you not agree?
That's correct.
Okay. So let's speak to the risk. You provided the only real comparable that you have for cap rate anyways for what would be 1033 Main Street. Would you agree on that? Direct comparable?
That's the only one in our capitalization rate study.
Having said that, we're both well aware that property did not continue on in an office mode. It was converted over to multifamily mode. It was underperforming the marketplace by such a degree that they had to change the actual use of the building. You created then a value for it going forward as an office. Why would you create something that doesn't exist? Why would you not put a multifamily capitalization rate on there?
Because the property was being advertised and marketed as an office. It was the purchaser's decision. It was the purchaser's decision, and it was a prudent decision because looking around the Winnipeg market, as I've been saying over and over, there is a concern. And they made a determination that the highest and best use of this property, and this has happened, I think, 5 times with downtown offices. Highest and best use is actually as multi-res, but it was on the market as an office. That's how it was marketed.
I'm allowed to finish. So basically the financial aspect in the future of that building as an office was financially insolvent. It was unviable. So they converted it over to multifamily.
No, that was the purchaser's decision to convert the property upon the lease expiries to multi-res. Any other investor could have decided that it remained an office. It was viable as an office, albeit with high vacancy. It had about a 32% vacancy.
But in fact, it was converted over to multifamily. And if you're looking at it as a risk moving forward, that building had significant risk to it.
Yeah, and I think that is not uncommon in downtown Winnipeg.
Right.
I should mention something else, Mr. Chairman. I went over that comparison very quickly. But when we impute the capitalization rate of 7.66%, it is using an elevated vacancy allowance, in that case of 20%. So we're not ignoring the vacancy. We're accounting for that in the NOI.
If we can now pivot to the subject property. You see the subject property has 2 primary tenants, desirable government tenancies, long-term, occupying the majority of their building. One being at 20-year lease, another one being at a 10-year lease, which I'm sure there's an option to renew. Would you not consider that as the ability for this building, this physical property to obtain those select tenancies?
No, it took years. No, I think what the important lesson here is it took years for the owner and significant dollars for the owner to secure these tenants. The other thing about these leases, I didn't go into detail because we're not arguing about the leases now, but these are semi-gross leases and they don't have step-ups. Government tenants are secure as far as longevity, but they're not secure as far as risk, because as expenses increase, which is inevitable, the erosion increases to the rental income. So actually, I think that this is not as secure a tenant as you would suggest, Mr. Poole.
Moving from that point, you lost me there because within the leases themselves, is there not renewals from base year or step ups to the base year for costs? Typically, it doesn't show up on the INEs, but after my review of the marketplace for the government, the province of Manitoba anyways, there are embedded within their leases renewals that don't show up on the INEs. Have you looked at the leases for these 2 tenancies?
I've studied the rent roll, and actually, if you give me a moment, I'll refer to that just to make sure. Yeah, I don't see anything about step ups on these leases.
No escalation clauses. There's no, as far as renewal or taking into account cost of increase for base costs over first year.
The federal government lease has a operating cost escalation because, of course, there is erosion being a semi-gross lease. But whether or not that escalation matches what actually happens in the market is a different question. Of course, we're into inflationary times as well. So,
getting back to the performance of the marketplace, and I'm glad you mentioned that the chairman was involved in another hearing about a month ago, which I'll point to specifically 333 Main Street and 191 Pioneer, where those buildings had significant significant performances within the marketplace that dropped basically change of tenancy within a few days of the reference date, or you disregarded the performance of the buildings and wanted to rely on information right at the reference date. It seems your position has been reversed now, where there was vacancy in these buildings, but at the reference date, we had 95% occupancy of 2 strong government tenancies and another strong SimCorp tenant. But you want to be reflected back to what it was. Why is
No,
there
not at all, Mr. Paul.
why is
Not
there
at
a
all.
negative position today?
Not at all, Mr. Paul. I am accepting the market vacancy as applied by the city. I'm accepting the market rents as applied by the city, which reflect the actual rents in place.
So why would that not account to the actual risk of the tenant, the vacant street as well?
Because the risk is based on the NOI.
The vacancy, that speaks to risk. Those are the 2 primary components to risk.
Yeah, we've already established that we're applying a market vacancy. We're not asking for anything higher, even though the property had significant vacancy in the past. We only look to the past to understand what is it about this property that may cause concern going forward into the future. But our valuation is based on what's happening today.
So standing at the reference date, a purchaser would see a 95% occupied building with long-term government tenancies, renovated floors. What part of risk would you see that is negative?
Well, the risk is, I'm not just saying the tenants are going to leave, period. We establish what a typical rate of return is for a good, solid Class B building. And typically that would be 6.75% is the median of what the brokers are suggesting. And we find that it's actually increased a bit because of the overall risks in the market, overall to everybody, to be around 7%. But there are factors about this property. If SimCorp leaves in a matter of a few years, it's a short-term lease. We have, again, a main floor that's going to be vacant. And if we look back, it was vacant for 7 years. So that's a risk. Yes, the provincial tenant has a 20-year lease and the federal tenant is on a 10-year lease. So that gives a bit more security in longevity. But again, semi-gross leases can cause erosion to rent as your expenses increase. It's not like a net lease. Instantly, if you're not on a net lease, you have higher risk.
Could SimCorp not simply re-sign?
Well, they could, yeah.
Thank you. I'll move on to the non-recoverables. I'll kind of generally go through it. On your page 10, it appears you're using leasing commissions and asset management fees. Do you confirm that that's part of what you're using?
Sorry, this is page 10 of the study, Mr.
Page
Paul?
10 of your study, yes.
Yeah, on page 10 of the study, just maybe I'll pause if the panel would like to turn to that page of the non-recovered study.
Okay, just give us a moment.
Sure.
Page 10, did you say?
Yes, thank you, Mr. Chairman.
All right.
So just to explain what we did in the study, which is Mr. Pohl's question, on any given financial statement, there often will be, not always, financial statements differ, but you'll typically see recoverable expenses, and below that will be non-recoverable expenses. And so that's the items that we're looking at in the study. And those items can include any number of items. There's all sorts. But what we found often, leasing commissions are a big one. Professional fees are a large one. Advertising and marketing, space marketing costs are a large one. Asset management fees are one. Sometimes we see it, sometimes we don't. It's a smaller one. And then, of course, tenant improvement allowance. That's different than the leasing commissions. And that is a touchy one. So what we did in the study is we broke it on page 10 into two columns. The first column is a 3-year stabilized of each of these properties, their non-recovered expenses without tenant improvement allowance. And the last column is the same non-recovered expenses, including tenant improvement allowance. So I hope that answers the question, Mr. Pohl.
Yeah, it does appear that you're using leasing commissions, and that's
correct.
Okay, so there's multiple case law that I presented, quite frankly, that disallows case leasing commissions, tenant improvements, tenant allowances, free rent, asset management fees, to the point where ad nausea, this panel doesn't really want to hear it anymore. Can you provide me a single municipal board order that shows that we're supposed to be included in any of those?
I don't have to, Mr. Pohl, because as I've stated many, many times, each of those decisions that you quote, which aren't in evidence, I don't believe, but I'll speak to it anyway. Each of those decisions was answering a question put before the municipal board, and that question was, can we deduct, or we would like to deduct tenant improvements and perhaps leasing commissions from our face rents to determine a net effective rent. And I mentioned in my presentation, we're not doing that. The question asked of the board was not, do these expenses exist? Or do we account for these expenses in other areas? And let's be clear, in every one of those decisions, a 7% non-recovered expense allowance was applied. So in my mind, those orders make complete sense. They're not going to double count for these items. The allowance was already in place, and we're not going to now also deduct those expenses from the face rents.
Moving on to your actual comparables, how many of these are OFBs or OFAs?
Sorry, which comparisons, Mr. Pohl?
Well, your comparisons 1 through 30. Obviously, we're doing the OFAs and an OFA today and an OFB. How many of them are actually in your study?
Okay, sorry, you're on page 14 of our evidence with the market rents?
Yep. No, 11.
Yeah, just to be clear, I mean, I can answer that question, but we're not at this point contesting market rents. So I don't know if that's a...
No, page 11 of your non-recoverable study.
Oh, I'm sorry. I thought you meant market rents. Okay. And you're asking how many are Class B offices?
Yeah. How many are Bs?
Portage Avenue East is number 2, would be. Portage Avenue number 10 is an A, I believe. Graham Avenue is an A, or no, that's a B, sorry. Main Street is a B. St. Anne's Road is a suburban. So there's a few here that are.
So of the 17 properties that rent out in my study that I've done 6-year analysis on a net basis, you've selected 3.
Yeah, it's an overall study of all asset types.
And you have
but the fundamental difference, Mr. Pohl, is that you don't include some of the major items that we do.
And that's where I'm defining it. What I'm saying is, do you feel that you have a complete study of the downtown OFA and OFB marketplace to begin with?
No, we do a sampling.
Is sampling, but you don't have a complete study.
No.
And then the difference is, of course, highlighting leasing commissions, which are large, obviously. We're including other factors that we, on our interpretation, quite blankly, it states they're not going to be inclusive of that. So there's the difference between the 7 and the 3%. So
yeah, that would be one of the major differences between your position and my position, is that you're not including space marketing costs.
That's the only question I have.
Ms. Davidson, questions?
I have no questions. Thank you.
Mr. Danjal?
No, I don't have no questions either.
I have questions. Which one do I want to go with first? Well, I guess I'd like to hone in on this recent discussion that you were having about the municipal board decision. And I have not heard it described quite this way. And I think the board members need real clarity on what the board decision was. With respect to the costs incurred by the landlord to induce someone. And I'll preface my real question, though, by asking, Mr. Slaughter, you said that the space marketing costs come into the non-recoverable expenses, and that part of space marketing cost was the tenant improvements taken on by the landlord, the requirements in order to induce the tenant to come in. I've never actually, I think, in the hearings that I've done, had somebody describe in detail what space marketing costs are. And to me, that sounded rather like advertising, rather than some physical construction and costs and that sort of thing. Am I correct in understanding that you're saying the tenant improvements are really within space marketing costs, and therefore that is legitimately part of the non-recoverable expenses?
Well, I think to answer that, Mr. Chairman, maybe I should go back to the study and quote some of the quotes from valuation textbooks. So I'll read this statement here. And this comes from the Case Studies and Appraisal 1 from the Sauder School of Business, Real Estate Division, University of British Columbia. The appraiser should also account for non-recoverable expenses, also called non-rechargeable expenses. The most important non-recoverable cost items to be aware of are space marketing costs, which include both tenant inducements and leasing costs, and an allowance for structural or mechanical repairs. The other costs associated with leasing space is leasing fees or commissions. So according to the appraisal text, yes, tenant improvement allowances should be considered. But what we've done in our study, because tenant improvements are that one item can be contentious. In some people's opinion, well, there's value to that tenant improvement to the next tenant. I can state to you, very seldom is that the case. But because there is that discrepancy, we did our study with two columns, one with and one without. And even without, we felt 7% is substantiated.
Okay. So then looking at that municipal board decision, Mr. Pohl is saying that the municipal board said these types of costs are not allowed. But I understanding that you are making a finer point, and that is that the municipal board said they are not allowed in that you cannot reduce the rent effectively because of those costs. Rather, they ought to show up in the non-recoverable expenses.
Well, that's my interpretation, Mr. Chairman, which I am cautious about. I'm not a lawyer, I'm an appraiser. But I read those decisions in a very different way. And the number one reason is, as an appraiser, I read valuation textbooks. I talk to owners in the market. I understand what actually happens in the market, and that is that these expenses are real. So that's number one in my awareness of these items. And then the municipal board order has a comment that we see from the city saying that we don't deduct tenant improvements. And one would say, well, the board is saying that they're ignoring that item. But when you back up and look at those decisions, there's a chronology, Mr. Chairman, to those decisions. It begins with this building that I'm sitting in, the Richardson building. Back in, I think the decision was in the early 90s, and it pertained to the 1984 reference date. A very interesting municipal board decision on how to value office property. And the appellant in that case had the argument that they wanted to deduct the tenant improvements from the face rents. So that would be the equivalent of me taking the rents that are attained in the subject property, 400 Ellis, and deducting all of the millions of dollars the owner spent, deducting that on an amortized fashion from that face rent. And in that case, Mr. Chairman, the Richardson building, the appellant dropped their argument. So there was no decision made. The board simply mentioned that that was an argument that the appellant didn't go through with. The next order in the chronology was it's called the Canada Life building. I believe that's 444 St. Mary. And this would have been a few years later. And in this case, the appellant did go forward with that exact argument. They said, look, this property had major vacancy issues. The owner put in all this money to attain these tenants. We want to take the face rents, let's say they're $10 a square foot net, and deduct the amortized allowances, which let's say were $3 a square foot over the 10-year leases, to come to a net effective rent of $7. That was the question being put forward. And the board in that case said no. And they said, we will not deduct tenant improvements. It was a rather blanket statement. But let's back up and think about the context of that statement. Number one, the question wasn't, do tenant improvements exist? Should it be recognized in the valuation? The question was, can we deduct it from the face rents? And I agree with the board. You shouldn't do that because somebody buying the property is buying those higher face rents. They don't care what the vendor had spent. The second point is that in every one of these decisions, the 7%, or in the older days, 8% actually, non-recovered expense allowance was applied. So from that, I sit back and I think, what is more logical? That the municipal board is answering a specific question, which actually is tantamount to double counting these expenses. That's number one. Or number two, what they're saying is, from now on, let's just ignore these very real expenses, which is basically tantamount to increasing values beyond market value, which is in contradiction to the Act. And I think between those two scenarios, which is really what the question comes down to, the difference in our opinions on what the board is saying, I think scenario one is far more plausible.
Mr. Pohl, what is your response to that?
Basically, again, there's not one decision. I mean, there was a dozen decisions that come from that. And effectively, they didn't say, some decisions say you can't reduce rent. Others to say you can't reduce expense. But in the end, you can't reduce market value. Wherever you put it into the equation, you can't reduce market value based on tenant improvements, which they highlight. And I have it in my study exactly what they stated as far as what you're to redact out. As far as whether, and I'll get back to really the crutch of it, whether it was 8% years and years ago or 7% more in recent times. Neither the assessment department nor any agent produced an actual study to define what that was. Everywhere I looked, it was just a percentage that they agreed or disagreed on. We have an actual study for what I presented for all of the ones that rent on a net basis for A's and B's. You have a study 6-year stable, like it couldn't be any more detailed than that. You do have a study that the agent did present today, a limited study sampling of 4 or 5 properties of A's and B's. Back then, you never actually had anything to go on if your panel member sitting there. It was either a percentage of your argument. So today, what you're hearing from both agent and assessor is, and admittedly, they've already included lease commissions, which is a big factor. Here's our sampling of 5 or 4 or 5 studies. Here's the assessors with a complete marketplace. And you think it should be 3 or 7. So if you're judging the percentage based on what the percentage was done prior, well, there was no actual studies done on it to come up with what it was prior. Today, you do have a full study from myself, part of a sampling of 5 from the agent. But realistically, you have to make the determination on whether you want to include those tenant improvements, allowances, leasing commissions, and again, I'm not going to read through them all there. It's in my document. Whether you're going to include that or not. So that will affect what the percentage is. We didn't. I followed the case law. I respected the case law. I'm not going to undo case law. It's not appropriate. So whether you choose 7 or you choose 3 or a number in between or whatever you choose, you should be going on the information that you see in front of you. And if you want to differ from existing case law when it's been done repetitively, I guess you can. It's your call. You're de novo, but that would be the same way in my eyes of looking at post-reference information or something else that's been set in stone at the municipal board. We should be respecting that. And if there is a difference between that, identify it and then present your argument as far as tenant inducements, why it should. In this case here, you see some case law, but that case law is trumped by the actual, I should say, you see some EPC quotes, but that's trumped by case law from the municipal board. Same ways, if you're looking at a property, you should be looking at a discounted cash flow to see what's coming down the pipe and what you're actually buying. But this board says you cannot do that. That's why we don't do discounted cash flow. So these quotes that are being produced here, I don't think should be held valid versus what the municipal board has already ruled upon. So having said all that, I think we're going to be heading into a hearing where this will be more discussed and more focused on coming this summer, and hopefully we have some answers for that. So for that, I'll let it at your decision.
Okay,
Mr. Chairman,
yes.
May I respond? I have 5 quick points to the assessor's comments.
Only 5?
Only 5. Very quick. Number 1, I mentioned the chronology of decisions. The assessor mentioned that there were other decisions after. Yes, there were, and they all refer back to the 2 decisions that I just mentioned. And in each of the cases, to my recollection, the question was the same. We want to deduct more. We want to deduct tenant improvements or something, whether it be from the face rents or somewhere else, when the allowances are already in place. So again, I think it makes sense what the board was saying, and you have to understand the context of those decisions. Number 2, Of course, the city study is going to come up with a different number than ours. They are ignoring the majority of the expenses that are included in this category. Number three, whether or not we use 7 or 3 or 4%, the assessor is kind of right in that way, as long as we're consistent in our methodology. Altus is the only one today bringing forward capitalization rates and how we derive them. And you will recall, we apply 7% in those cap rates. If we applied 3% or 4%, our cap rates would be higher. If we didn't apply a higher than market vacancy with 433 Main based on actual performance, our capitalization rate would be higher. So we need to be consistent, and we are. That is why I argue non-recovered with cap rate almost consistently. Number 4, he mentions that, yes, we used 8% or 7% in the past. Well, these expenses, I think everyone would agree, are only increasing, both because of inflation and secondary because of the tenants market. These expenses are only going up. Number 5, discounted cash flow. Interesting point. At the end of the day, I think the assessor would agree that if I was to value this on a discounted cash flow or a direct capitalization approach like we're doing today, we should come up with the same value, or else you've done something wrong. And a discounted cash flow certainly includes in the annual deductions as you go through the cash flows of the holding period, tenant improvements and leasing commissions. They are included. So again, it doesn't necessarily mean the direct capitalization rate has to apply the same deductions, but you have to make sure that your methodology is sound and that your capitalization rates reflect the same methodology. We have done all of that, Mr. Chairman. Thank you.
Thank you very much. That's all my questions. That then concludes 400 Ellis Avenue on our docket. And I'd like to take a 10-minute recess, and then we will resume.
Thank you.
We are live.
Okay, thank you very much. Then we are proceeding on our docket to item number 3, which is 251 Portage Avenue. Mr. Pohl, when you are ready.
File number is 22-2318. Roll number is 1305-2164-000. The address is 251 Portage Avenue, sometimes referred to as 259 Portage Avenue. The 2023 assessment is for $13,961,000. I'll have a recommendation from that value, and that value will be down to $10,700,000, and I'll get to that in a moment. The building was built in 1915. As you can see, obviously the effective increase to the year, given the improvements over the number of years, to 1975. There's a leasable area of 98,663 square feet. On page 2 of the pictures of the property, and it sits on the corner of Gary and Portage. There was a sale in 2015, which I will get to as part of my rebuttal, or however you want to use the rebuttal. It's just information on the sale itself. Nothing more than actually what was given the consideration sworn value in the sale price for 2015. So on 2000, or for the comparables from 2018 to 2020 is on page 5 and 6. As you can see, the average weighted average is $13.08. The median is $12, and the average again $12.62. So that's a fairly tight range for 59 comparables. When you go through the property on page 7, it has experienced a higher degree of vacancy. We have a 15% standard parameter at 15% vacancy. I'm going to make an adjustment to 20. And I'm also going to make an adjustment to rent from $14 to $12.50. So I'll go through the new numbers now. And if you want to get your pen out, that way it can you can transcribe them properly. So for the 98,663 square feet, an overall rent of $12.50 can be applied, which produces a potential gross income of $1,233,287. With vacancy of 20%, gives an effective gross income of $986,629.
Sorry, what did you say? 986?
$986,629.
Thank you.
Again, our expenses that are non-recoverable 3%, and that's $29,599. And our shortfall at $10 is $197,326. And that produces a new net operating income of $759,265. So capped at 7.1%, and I make no change to the capitalization rate because the 20% vacancy and the reduction in rent to below average accounts for that risk. So that then reduces the $10,700,000. And when you look at the property, how it was purchased for $10 million, even though it was 5 or 6 years earlier, you can see that this particular property may be plateauing a bit market value with risk and tenancies and everything associated with it. So I don't think an increase from of 700 the 10 million that was already existed and paid for, which would have accounted for all the risk associated with that purchase, which is what you see today as far as the vacancy and how it's performing. I think it's appropriate. So with that, it's you can get to the rent roll if you like. A little small, and I apologize on the pages in the back of the brief, but I feel the reduction made is most appropriate. So with that, I'm open to questions.
Well, let me first turn to the applicant. Is this recommendation acceptable to you, Mr. Slaughter?
No, I don't think our client would accept that, Mr. Chairman, but I do thank Mr. Pohl for taking the time to look into that. It's very good. Thank you.
All right. In that case, did you have anything further to add, Mr. Pohl?
No.
Okay. Mr. Slaughter, questions?
Thank you. Mr. Pohl, you mentioned the property, it's a heritage office built in 1915. The city's applied an effective age of 1975. Can you explain how that effective age may be determined?
That would be encompassing of all the permanent work that would be taken out on it. Inspections over the years going throughout before my time, obviously, at a current level. So, again, it's a more model value with a perspective on what was done in the building.
So it's more of a, I mean, you're looking at permits you mentioned, but otherwise this is objective interpretation based on an analysis which includes permits. Is that safe to say?
I'm not going to change the effective year built unless I see something dramatic. Over the years, that effective age will be updated by multiple assessors, multiple authors. So I don't see a reason why I would think it would be that.
Fair enough. The property is classified as an OC, and just to clarify for the panel, the assessment department actually has 4 categories for office. It goes from OA to OD. So there's a B, C, and a D category, correct?
Yeah, and there's an OFS and there's an OFM, but I mean, those are.
Yeah, sorry, I'm for the downtown mainly. But what is the difference then between C category and a D category?
Well, I mean, where I take it from the perspective of is before you start applying what a BOMA, because typically we use the single approach that we just adopted marketplace approach, which is BOMA. But typically what I look at it is how the building's performing. What's the income that's being generated on the building, and that's really what you look at before you can start getting into what's a C, B, what's an AB, how is it performing, and so far. So this case here, we have it graded as a C. It will be a lower grade C. I don't think it's a D. That's your perspective.
Okay. Yeah, just to be clear, BOMA would be only, they only go from A to C, correct?
Yeah,
There isn't a D. Yeah.
There is.
Similar sort of heritage offices like this. I think of a sister building called the Electric Railway Chambers, which is around on Portage and Notre Dame, or the properties along Lombard. Those are typically Ds, are they not?
Most of them are Ds. I mean, I'm hard to all at once kind of thing, but yeah, I think most of them are Ds.
Okay. On page 5 of your evidence, you have page 5 and 6, you have 30 or 59 comparisons strictly of OFC category rents, correct?
Correct.
So of these, are there any that you think are good? I mean, I look at this list and most of these OFCs seem to be kind of the mid-century or later, like 1950s, 60s, 70s, 80s builds. Is there any here that you feel are comparable to the subject in that they are downtown heritage buildings from the turn of the century?
If you're looking, did I do these comparisons on a heritage only perspective? No, I didn't take that into account. I don't think there's enough of them that you could actually do approach in the reference stage where you'd actually have a good enough sample. So no, we didn't take that into account. As far as age, typically your OFCs are going to be older. You don't have 1980 or 1990 OFCs up there. They're usually an older stock property.
Yeah, so I'm looking at the top of the list. You have 4 comparisons from 1780 Wellington. Just to be clear, that's a 1990 build office tower near the airport with ample parking, correct?
Yeah, correct.
Yeah. So you'd agree that's not really comparable to the subject.
Again, it's on Wellington. It's a newer building, but it's part of the C class. It's not a. You're going to have variances within the C or with any property type class, but no, it'd be a better performing building for sure.
So if I look at, if we turn to page 6 and we look down the list, the 2 properties on Bannatyne, I think, are fairly good comparisons. 115 Bannatyne and 136, and Market, 136 Market. And looking at those leases, you'd agree that, I'm looking at between $7 to $12 a square foot. So if we honed in on that type of property, which is more comparable to the subject, in my opinion, your average range would be lower than what you're stating from the overall Class C. Would you agree?
I'm taking it from a broader market perspective, as I do with all of these, and the panel can choose whatever they feel is most appropriate. They don't have to go with the average. If they want to key in on any particular comparable, they can. What I'm trying to do is, when we present this information here, is I'm representing all of the marketplace, not a select sampling of. So you get a broader perspective of it. And obviously, when I looked at this property at a $14 rate, it is before that's not appropriate for the way this property has been performing. So when I reduce
So
it
you made
down,
an adjustment. Yeah. Yeah. And I appreciate it.
and when you factor that in with the vacancy, that is a significant adjustment. So it is in the lower end of the marketplace now, and the performance of the new the new valuation that I presented today at 10,700,000 reflects that. And when you look at how it was purchased, when it was purchased, you would see all that risk associated with it. So when you see the two, an underperforming market, a property that's underperforming in the marketplace, isn't going to rise maybe at the same rate as other ones that are more in line with market. So I think we've done a more than appropriate reduction here to account for all these.
So what you're saying is you have looked at the actual performance of the property, the actual rents, the actual income, and that was an influence for you to make the adjustment that you're presenting today.
Yeah, we're only 700,000 over the sale price, which a purchaser would have seen all that moving forward. I don't think that's inappropriate at all. I think it's right in line with what occurred, and a bit on the conservative side for the property owner.
So let's talk a bit about that sale price. Number one question is, you're stating it's 10 million, but the owner had completed a sales verification questionnaire and they stated that the sale price was actually just south of 9.5 million, correct?
I believe so. I don't have that here today, but as far as the information I have as far as rebuttal, I do have the actual information that they paid as far as fair market value and the sworn values.
And having reviewed the property's performance, you'd agree that at the time of the sale in 2015, the 3-year stabilized income leading up to that sale date was about 760,000. Would you agree?
I don't have the numbers right in front of me, but yeah, that's what you're saying.
Okay. And on page 19 of your evidence, if I can ask the panel to turn to that. This is the financial statement for the year end closest to our reference date, the year end 2020, I think it is. And it's hard to see that number, that total net operating income. It's about 4 lines down on page 19. It's before any non-recovereds are deducted. So notwithstanding non-recovereds, that net operating income, does that say 388,000?
Oh, you're testing my eyes today.
Yeah, it's tough to see that.
I don't have a PDF file. If you have a PDF file, blow it up and read it for me. I apologize. It's too small for me to read.
No problem, Mr. Pohl. I think looking at my evidence, it's the same quality, unfortunately. But
we're both handcuffed with what they give us on a PDF file. Blurry as it comes in, it's going to be blurry as you see it. So
no, it's fine. So my last question is, assuming that is correct, which, having blown it up, I know it is. You'd agree that net income is about half of what the stabilized income was leading up to the owner's purchase of the property, correct?
Generally agreed.
Yeah. You'd agree that the vacancy at the time of sale was hovering at 15 and today it's hovering at 38%?
Yeah, no, there's a high degree of vacancy, but that's why we're putting it. When I put a 20% on, what I'm saying is, and just so we're clear, and this comes from municipal board orders too, I mean, a 25% chronic vacancy, what you're saying is that building's going to be vacant into the foreseeable future. There's obsolescence, it can't be occupied, and if there's a residual amount of it, tenancy, okay. At 20%, that's still considered chronic. I'm still saying that at 20% that this building is going to see a significant amount more than market into this foreseeable future. And you see that. So at 20%, I'm fine with. If it was majority empty, then we'd be looking at a more, your maximum of 25%. So, and I don't see that within the building. So I think a 20% allowance for vacancy staying into the future, any prospective buyer would assume that it'd be 20% moving forward on a pretty continual basis would be appropriate.
Yeah. So sorry, Mr. Pohl, I may have missed this, but just to make sure I understand then where we might be in agreement, because we're using 20% as well on the vacancy. So your rents, you said you adjusted downwards from 14. Do you have a blended market rent that's now being applied?
At $12.50. Sorry, did
Sorry,
I?
I missed that. Yeah.
Yeah, I basically
$12.50.
put it at the lower end of it with a higher vacancy, so. And I think it accounts for what you see within the building, so. And when you, and like I said, when you look at it independently, but the numbers came in at $10,700,000, okay. And then when you look back at what the actual purchase was, which would be inclusive of all the rest moving forward, as you see moving forward from a prospective purchasers at that point in time. It's pretty much in line with what's been occurring on site.
Yeah, I disagree with that, but okay. Thank you very much. That's all the questions.
Ms. Davidson, questions?
I have a couple questions. So you came out with some new numbers. Were the first ones all based on model?
Yes,
And then, so the new numbers were based on,
my review of the property.
so of all the elements of the property?
My review of the property, but also inclusive of the applicant's brief as well.
Okay,
So I didn't review the Class C properties. This is the first time I've looked at this one. And in this case here, I had some history in case management of this property, obviously. So the appellant, but as far as this cycle's appeal, this is the first time I looked at an appeal and it was a little high. So given the issues that occurred, like I highlighted on site, I think it's almost appropriate to give a 20% vacancy and a reduction in rents.
and I heard the questions that the applicant had asked about the rent, but I just wanted a little bit more information on, you've brought your rental rate down to $12.50 a square foot.
Mhm.
So I'm looking at a couple things like the comps, like none of them are in the magnitude of the 98,600-ish leasable area.
No, that's for the entire building. That's the overall,
Okay,
right, applied to the overall leasable area. As far as the tenancies within the building, you can see we have it on page 6. Where
okay.
different tenancies or CRUs.
Oh, yeah, there they are. Yeah, yeah.
They are, so whether there is multiple tenancies occupied or multiple CRUs occupied with multiple or the same tenant, I should say, that happens in every building. So overall, I think a reduction at $12.50, which is under market rate, but $1.50. And a 20% vacancy is pretty appropriate. That's the thrust of the
Okay,
reduction.
just remind me, these rents on the page you just pointed to, which page am I? On page 7, those are like model rents, they're not actual, right?
No, those are model rents.
Right.
All of that was model. The actual rents that occurred within the marketplace are on pages 5 and 6.
Okay, so
Go
the
ahead.
actual rents for this property, like the average, like you'd come up with an average of $12.50. Do you know what the actual average is for these rents? I meant for these tenants?
For the building itself.
Yeah, like that's comparable to your $12.50,
You can, if you wanted to look at what was,
like the
and
rent
then
rolls.
if you want to look at what's in the agent brief, which will be seen in a moment, they
Okay.
have a rent roll highlighted.
Okay, well, I'll wait
versus-
for that
so,
then.
yeah.
Okay, thank you very much. That's all my questions.
And I apologize for the rent roll itself being in and what they're submitting to us being small, but
Well,
that's the PDF and the
yeah,
shots.
not much you can do about that. Okay, thank you. That's all my questions.
Mr. Danjal, questions?
No, I don't have any questions. Thanks.
Okay, with respect to page 7, government agency is a fair bit of the square footage in this. Are those, like our previous case, long-term leases?
If you start on page 20. Winnipeg Chamber of Commerce is in the building,
Sorry, just a second. Did you say page 20?
page 20.
Oh boy, small print. Hang on.
I believe that was a 10-year, yeah, I know, it's a 10-year lease, started in 2013, it runs to 2023. Investors Group is in there as well, Province is in there as well. And that would be the two, obviously, two government tenancies.
So what kind of range in the length of tenancies are there in this building? Are the government ones all relatively long term?
Usually they are, I mean, generally they are. You don't really have a 3-year lease for a government tenant. It's usually about a 2-term 5-year lease and then an option to for a third usually. Usually they're about 10 to 15 years. In this case here, we have Winnipeg Chamber of Commerce. I think it was 2013 to 2023, so it's about a 10-year lease. The province, 2009 to 2024. And then I don't see, at least for the one CRU, I don't see an end date for the other provincial lease. So, but I'm sure it'd be similar to the other one there. So, and usually the rent rolls are clear. I said I apologize. Usually the rent rolls are clear, but they're not today.
Of the non-governmental leases, how much variation is there? How, generally speaking, how long are those tenancies?
Within the subject property, I'd have to read you the rental.
Perhaps that's
For the first one is 5 years. For unit 220 is 5 years. For unit 240, it is looks like it's 13 years. For investors group, 5 years. And again, I don't know if there's options after that. Usually not. But typically your marketplace is 3 to 5 years with an option to renew. And government tenants is usually they're an anchor tenant or of sorts, depending on what they occupy. And they're usually a 10-year to plus an option of another 5. So,
and are these gross or net?
Government province would be are usually semi gross. City would be net. No, I apologize.
I can address these, Jeremy, in direct.
That's why I was highlighting on page. It's a little easier on page 15 if you want to address what the agents read through. It's better summation you can actually read.
Well, we'll listen to the agent then. In your opinion, though, Mr. Pohl, is this an expensive building to operate? Is it relatively efficient? It's relatively old, but
I didn't do a sampling of like my marketplace study stopped at the B class. Typically, our expenses are greater at other buildings. As far as it is in line with other C's of its age, I didn't do a comparison.
Okay, all right. Well, that's all my questions. So then if we could turn to you, Mr. Slaughter, for your evidence.
Thank you. Sorry, Mr. Chairman, you brought up something. I wanted to ask one follow-up question, if you don't mind.
Yes.
Mr. Pohl, on page 7, the chairman was asking about, I just wanted to confirm something. You made an adjustment to the rent to $12.50. That's applied to the 98,663 square feet, which includes on page 7 about 8,000 square feet of storage. Is that correct?
I did it to the overall. I apologize. Take out the storage, leave it at 497, which is 4,493 square feet for premise ID number 28248. There's another one there. That's the only storage I have. So it's not 8,000 square feet. Unless I'm reading.
There's one fourth from the bottom as well, 28248.
Oh, sorry. Yeah, no, I apologize. Yeah, they should be typically we agree about $5 for storage for building like this. So please make that adjustment. I apologize for missing those two.
Sorry, does that mean your market rent and your value would be lower than 10.7?
Yeah, you'd have to make an adjustment from that. So
okay, thank you.
if you require me to do that, I can do that on a break.
Sure, why not? When we break next. Okay, so Mr. Slaughter, your evidence.
Thank you, Mr. Chairman. So if I could ask you to turn to the direct evidence, Altus Group, City of Winnipeg, Border Division 251 to 259 Portage Avenue. And I'll just move ahead here to page 6. I had a chance to inspect the property again January 6th. Been through a number of times. There's pictures of the lobby, 3 elevators, and then the upper floors. We have some pictures of the vacant floors and a recently occupied floor. So you can see the degree of finish in the building. It's a heritage building. It's on the historic building list. Originally constructed in 1915, it's known as the Paris Building. So a few things that I'd like to point out. Number one, the city and the owner have a difference in leasable area. The city uses, I believe, 98,600 square feet, and the owner consistently, year after year, reports 91,071 square feet. And the difference, Mr. Chairman, is basement storage. I have some photographs on page 10. Only some of that space is caged for rental, and there is a bit of storage income, but certainly not all. And you can see on the second page, it's just kind of an open area. It's just unused area. So one of the differences is that when the owner does not report storage areas like this or unused areas as leasable, we follow the owner's direction. But we make sure that we're not ignoring that they are attaining income for that space. So you will see a lump sum addition for the storage income that they attain over that basement space. The second thing about this property, so we've got the basement, basically storage and mechanical or unused space, and then main going up to the 11th floor of the building. There's no parking at all with this property. The nearest parking is at the Gary Street Parkade, is it called? It's around the corner. It's an unheated parkade. And this is a concern for the tenancies. I know from both talking to the owner and certain tenants. This is not a positive feature of the property. So on page 15, Mr. Chairman, we start looking into the actual rents in place. Now, to answer a couple of your questions, very few of the rents in this property are more than 5 years. Typically, you'll find 3 to 5 years in this property. Chamber of Commerce had a 10-year lease up to 23, at which time they were vacating. But otherwise, the rents shown are on page 15. And to answer your second question, yes, typically the rents in these type of properties, that is turn of the century offices, are going to be gross or semi-gross. The owner, again, this comes back to my points made about 400 Ellis. That is not an ideal situation for an owner. That actually introduces risk because costs may escalate further than the escalation allowed in the leases to recover expenses, and you're on the hook. Triple net is the ideal. The owner would love triple net if tenants would pay, and they advertise on a triple net basis. They would like, their asking rent as of April 21 is 1075 net. They've never achieved that. You'll see on page 15, Mr. Chairman, the most recent net rent signed in the building is unit 300, and that's a non-government tenant, intergroup consultants. They signed a 5-year lease with a step up in March of 21, and the rent stepped up at that time to $9. It started, I believe, at $8.50. That's a typical net rent in this property. Otherwise, the rents are gross or semi-gross. What we've done is analyze the actual recoveries for every tenant, and we match that to the expenses stabilized between 19 and 20, and we make the deduction of the erosion. And you'll see those calculations on page 15. We go from the face rent, which will be this gross or semi-gross, and we deduct what is unrecovered from that to bring it down to the net, not net effective. This is just the net rent after the recoverable costs that the tenant doesn't pay based on their lease are deducted. And those rents, you can see what is happening is the older leases will typically indicate a higher rent. The rents are declining in this property. It's not uncommon. I mean, over all the offices I'm talking about, we are in a tenant's market. It's getting harder and harder to attain those kind of rents. But the average of the rents you can see ranges between 770, or so not the average, but the rents range between 770 to the highest is for a dentist who actually vacated. This tenant left in April 21, so at the reference date, they're no longer there. But they had been paying what would equate to the net of 1474. That was an anomaly. And that was when I take off the expenses from their gross rent, but they vacated. So you can see that they're not performing at $12.50, even for the non-storage spaces. And that's why I don't think the owner would accept, although I do appreciate Mr. Pohl looking into that. So what we've done, Mr. Chairman, is we've applied the actual rents in place. I'll pause there a moment. I'm sorry. What we do first on page 17 is we look to the market. And when we look at market rents, we're trying to find properties that we think are more comparable. And when I say that, I mean the turn of the century office buildings downtown. I really don't think we're going to have a very accurate market rent estimation if we start looking at Class C buildings or suburban buildings or buildings built in 1990, for example. I think we need to stay more comparable. I'd like to read a quote actually before I get into that, Mr. Chairman, and I kind of skipped over this because we didn't talk about market rents in the last presentation. I've mentioned a few times about the market that we're in as of April 21 being different than the market in the past, and it's mainly because of number one, supply outpacing demand, and then number two, which is more of a risk element, not really seen in the rents yet, is the specter of the hybrid work model. But I'm quoting on page 16 from Cushman Wakefield in their report for Q1 2018. So I'm backing up to give you the context of the tenants market. Landlords in the CBD will need to be aggressive as tenants pursue opportunities for superior quality space or more attractive leasing terms. The key factors in the decision-making process by tenants will be the leasehold improvement allowance and the commitment by landlords to undertake significant building upgrades. These are those costs. They just keep going up, the non-recovered costs. In particular, there will be increased pressure in the Class B market as a result of rising vacancy rates in 240 Graham and 400 St. Mary. That was back then. The point being, Mr. Chairman, is number one, tenants market means higher costs that have to be spent by the landlord that they can't recover. And number two, you do see, because of this musical chairs of tenants moving building to building, they're being enticed to better quality. And the buildings that are really suffering are buildings, I mean, everything is suffering out of this, but really the subject property and properties like that are having a difficult time. And we see that. I'll mention this when we get to vacancy. We see the vacancy in this property going from 15% up to 38% at the reference date. And rents, the most recent net rent they can achieve is much less than they would have in the past. Now, in Q1 21, at the reference date, Collier's Winnipeg Office Market Report states, in general terms, rental rates remain relatively flat in general terms. So at face value, you'd say, oh, rents are stable. But lease inducements have increased, compressing net effective rates in Winnipeg CBD. This comes back to my point I keep making about our valuation. If we're not recognizing these in our net rent or potential rent, these escalating costs, we need to recognize them in the non-recovered expense allowance. So, page 17, Mr. Chairman, is a list of downtown heritage buildings. And for the panel's reference, I have photographs of each of them from page 25 through 28. And you will see that most of them are, at face value, very comparable to the subject property. The first 11 are across Main Street on Lombard. And those rents, when we get down to the nets from the semi-gross or gross rents, are ranging from an average of about $6 to $10 a square foot. We then have a second building on Lombard. It's the Grain Exchange building. And those rents are ranging from about $8.50 to $11. There is one basement rent here shown at 50 cents a square foot. We then have a property on Main Street, which is occupied by a college. It's a two-story property with parking 2 sites over included in the rent of $11 a square foot. We then have what I think is a very good comparison. I consider it the sister building. I think both these buildings are very impressive to our downtown landscape. I think they look great. Paris Building, the subject, and the electric railway chambers is around the corner on Notre Dame. So that's the next set of comparisons from 19 to 26. And that's a nice building. They range from $8.50 up to about $14.17. That's right in the range of the subject property. Pretty much bang on. Bannatyne is another turn of the century building, and they range from $7 to $12. Rory is actually a superior building. They had a 2016 edition, a whole floor put on, but that's at $10.29. And lastly, another property on Market. By the way, that property, the one on Market, is also in the city's evidence, and they range from $10.73 to $15. This is again a superior property in that it has parking surrounding it. But the point being is when we look at more comparable properties, we have a very different average, and that is $9.50 a square foot. I come back to the point that the owner is asking, and asking is not usually attained in a tenant's market. $10.75 net, and the most recent rent achieved on a net basis is $9. So when we look at the actual performance in the property, we recognize two things. It is on par with its best comparisons. And when I say that, all properties are basically decreasing in their rent potential as we move into the April 21 reference date. So on page 19, to determine the potential market rent, Mr. Chairman, we therefore, and this is what we do, we consider actual rents the best indicator of market unless there's a reason not to. If it's not arm's length, if it's aged and there was different motivations involved, etc. But in this case, it passes the test. It's at market. We apply it as market. And to the vacant space, we apply $10.50, which I think is actually on the high side based on what I just described. So on page 19, you'll see the application of those rents brings us to a blended rent of $10.99 a square foot. And again, that is only for main floor to 11. It's not including the basement space. On page 21, I'll just skip ahead because I'm going to answer now, well, what did I do about that basement space? What we do is we analyze the financial statements and we look to the line item storage income and we try and determine if it seems rather stabilized over 2 or 3 years. And we've applied that as a lump sum addition to the net income. It's $10,800. Now backing up to page 20, the vacancy. Actually, you know what, Mr. Chairman, I'm going to save a lot of talk here because now I think the city and Altus are agreeing on the 20% vacancy. It's not even close to what's actually happening at the property at 38%. But as Mr. Pohl had mentioned, we don't use actual vacancy. We look at a 3-year stabilized, we look to market, and we find something that makes sense in between. Also looking at the trajectory of where the vacancy is going, etc. Many factors would come into play, but our conclusion would be 20% seems appropriate. We, I think, are in a slight disagreement on the shortfall rate. Again, the shortfall rate is to reflect the recoverable expenses that the owner does not recover with vacant space, not the non-recovered. That's something different. And to the best indicator of this is typically, let's look at what's actually happening in the property. And the actual expenses, the op costs and taxes are $12 a square foot approximately. So we've used $10 a square foot as the shortfall rate. I think that's a bit higher than the city, I think. Non-recovered expenses, I won't go through this again, Mr. Chairman, but again, I feel it very important we have to recognize that expense, and we ask the panel to apply 7% of the EGI.
Sorry, but before you carry on,
Yes.
Mr. Slaughter, do you mind verifying the shortfall rate, whether that is different from the city?
Oh, sure. Yep. Definitely.
You were unsure.
Well, it is. Apologies. It's the same. The city's applying 10.
That's what I thought.
Okay.
Okay.
So we do
Okay,
differ
carry
on the non-recovered expenses, and I won't go into that again, Mr. Chairman, but again, I think it's very appropriate for this property, 7%. And so long as an appropriate net income is applied based on our rationale, we would agree to 7.1% as a cap rate. And that was a tough one for me because really the best indicator of the cap rate in this case is that property I mentioned at 433 Main. Let's just step back and talk about that for a moment. That property was marketed as an office. Let's be clear. It was the purchaser's decision to change the highest and best use. And that property had a vacancy which was almost identical to the vacancy occurred in the subject property over 10 years. Started at around 15, hovering to 20%, and gradually kept increasing to 32% at the time of the sale. Well, the subject went from 14% at the time it was purchased and now has escalated to 38%. So a bit more of a drastic trajectory, but otherwise fairly similar. And we had used 20% as the vacancy allowance in our determination of the capitalization rate of 433 Main. Okay, so Just so the panel understands, we're using the exact same methodology. We used a 7% non-recovered allowance. We used contract rents with market applied to vacant space, which hovered around $10 or $11. It's almost identical. It also is a property that is kind of outside of the, not connected to the walkways like the subject property, and does not have associated parking. In all ways, I think it's a fantastic comparison, except that 433 Main was built in the 70s. The subject property was built in 1915. And you will recall that based on that methodology and those rates and allowances applied, the capitalization rate we calculated on the actual arm's length purchase of that office tower was 7.66%. We're accepting 7.1%. So on page 23, Mr. Chairman, is the summary of our income approach. We're lower than the city on the market rent. We're at $11 approximately average, not including storage. We're agreeing with the 20% vacancy allowance, and we're agreeing with the $10 shortfall rate. We disagree on the non-recovered. We apply 7. We add storage income because we do not have it included in our leasable area. We have a net operating income of $573,347. We capitalize that at 7.1%. I will pause again. You will recall in the questioning, I referred the panel to page 19 of the city's evidence, which showed the 2020 financial statement. And you'll recall that the number that you'll probably have difficulty trying to read as the NOI before we deduct non-recovered expenses of the subject property was $388,000. And that is basically stabilized with the NOI experienced at the property over the years before. So I'm going to mention 2 things to the panel. Number 1, the sale price in 2015. At the time of that sale, the property sat at a 14 or 15% vacancy. The net income, the 3-year stabilized net income leading up to that sale price was just under $800,000. Flash forward to April 21. The 3-year stabilized NOI at the reference date, when we take the 3 years preceding, is 420 or 430,000. This is why I cannot accept the offer being made by the city on behalf of the client. I know the client would say no. The second point I want to make, Mr. Chairman, is that our NOI is at $573,000. And I hope I've explained exactly the rationale and exactly how we got there. And I believe that it is sound. But it is higher than both the actual NOI at the reference date and the stabilized 3-year leading up to. And this is an important point because you'll hear about this back and forth depending on the property. We shouldn't just look to the NOI stated on an income statement. I've mentioned this many times before. That's what we call a leased fee calculation. And what we're doing here is a fee simple. We're applying market parameters and market rates, which may be higher or lower than what is incurred at the property at the time of the valuation. So I hope that explains 2 things: why we are higher than the actual performance of the property in our valuation. And number 2, why in other cases you may see a property, especially 100% occupied properties, that have an NOI at the reference date much higher than the fee simple valuation, because the fee simple valuation will include a market vacancy allowance, a market shortfall allowance, a market non-recovered allowance. In conclusion, Mr. Chairman, capitalizing the NOI at 7.1% results in a April 21 market value of $8,075,000. As a note, that per square foot value is very close to the per square foot value of the property I mentioned at 433 Main sale price in 2019. And that concludes our presentation. Thank you.
Mr. Poole, questions?
No, other than the square foot area you attributed to somewhat less storage area in the basement. We had about 8,500 or so square feet of storage area. What is your take on that? Are you just using their lump sum as far as what they generate and disregarding the area?
Yeah, when the owner doesn't include storage areas in their leasable area, we follow their net leasable area, but we're careful to not ignore any income they might generate from that storage area. So we add it as a lump sum amount.
Okay. That's the only question I had. Thank you.
Ms. Davidson.
I just want to clarify the fact that the applicant, you're using other income for that storage area. And the assessor, are you using, you're counting it as part of the leasable? Or are you going with his methodology?
They just took it as a lump sum
Right,
rent,
Yeah.
we're taking it as
right.
storage, and then we're applying the vacancy to
Right.
that as well, where
Right.
that would be in that way.
Okay, so that wasn't the recalculation you were talking about doing.
I'll
Now
have
with
that,
him,
I'll have that,
but you're not going to the applicant's methodology of using the storage as other income.
no, I still redid it with vacancy put on.
Okay,
So
sorry,
I
that
have
was
that
kind of
number.
both questions.
I have that number now, if you like.
Okay, thank you. Sorry about that with both of them.
Nope, that's good.
Okay. That was it. I just wanted to clarify how each was actually doing it or whether it was consistent. Okay.
Thank you.
Mr. Dunjal, questions?
Well, that answers my question too as well. Thanks. That's all I had.
So Mr. Slaughter, I'd like you to back up a couple of minutes. You kind of lost me in your discussion about fee simple valuation, the difference between that and using actuals. The reason why I sort of got lost was I was starting to think, well, hang on. Municipal board says that there is a preference for using, say, actual rents to models, if I'm correct. Could you replay that point that you were making, please?
Yeah, and I admit I'm stepping into murky water with this, but the point, Mr.
Oh,
Chairman.
good. And I don't feel so bad.
In a nutshell, the point that I'm trying to make is that the board probably notices that the net income that I'm proposing on our valuation is much higher than the actual net income incurred in the property, both at the reference date or year end 2020. And if we looked at, if the board had it in evidence, when we looked at 18, 19, and 20, it's much lower. And I need not have gone into this discussion now, but what I find happening is when that net income is higher than the valuation proposed by a fee simple analysis, it becomes a very big point brought forward saying, well, you must be off because the actual NOI is higher. And my point is that when we look at the actual income statement, the actual income at that time, for example, the actual income in the property is based on the fact that there's 38% vacancy, right? So that's a huge erosion that drives down the NOI, the actual NOI of the property. But we're not, neither Mr. Pohl nor I are suggesting that we use the 3-year stabilized actual vacancy of 38 or 35%, which would drive our value down. Because in a fee simple analysis, we recognize that we have to look to market as well. Now, this is where the two roads divide. One might say, well, you look to market, so you ignore actual. Well, not at all. The boards have been very clear on that. The boards have said that actual is your best indication of market, because actual, you need not now make adjustments for all the differences in the other properties. You have what actually happens at the property. But in saying that, you still need to recognize that the occurrence at the reference date, what's actually happening in the least fee income, is not necessarily what a purchaser's buying going into the future. It's a good indication of some concerns the purchaser should have, but you would balance it to the market and you'd come up with something different. And the biggest difference, Mr. Chairman, is if you have a single occupant building, zero vacancy, and you look at the actual rent and you come down to the NOI, your NOI is basically going to be your rent, right, in a net rent situation. And if you look at the fee simple valuation prepared by either the city or usually most appellants, you're going to have something much lower because you're applying a market vacancy allowance, a market shortfall allowance, a market non-recovered allowance. And so I just wanted to bring that forward, that I find that I'm often having to make this argument when the city says, aha, the NOI is much higher than what you're saying, so therefore you're wrong. No. And in fact, in this case, the NOI is much lower. I hope that answers the question.
Well, it raises a few more. So are you saying that, basically the city's model is fine. They're doing fee simple because they're modeling each of the different parameters. However, the municipal board has said, at least with respect to rents, you got to look at the actuals.
100%.
But you're saying that if there is a parameter that is really far off what would be reasonably assumed by a buyer, then you've got that drives you to market rather than actuals. Now you're saying that in this instance, it's the vacancy that would drive it down from the 38 to the 20%, which is more reasonable on a fee simple basis.
Mhm.
What about all the other factors? Does one alter any other one using the same theory, therefore driving you towards market rather than actual?
Well, you have to be careful because at the end of the day, the number one thing that we're all trying to do today based on the act is determine the market value of the property. But what the boards have said is that, in that calculation, you're not just, or not, it's not really what the boards have said, but appraisal theory would suggest that you don't just look at the NOI at a given time because it may be high or low compared to what might happen over the economic life of the property. And so you need to test that, and you may need to make adjustments. And you may need to make adjustments to rents as well. I mentioned if you have a non-arm's length rent, for example, in your property, you'd probably best test that to market. If you have a rent that was motivated in some way because it was from a leaseback transaction or some other factor, you need to test that to market. So you may stray from contract rents a lot of times. But the best indicators are typically what's actually happening in the property, stabilized. So with vacancy allowance, the boards have been very clear. If the stabilized vacancy is higher than market, one should probably recognize that in their valuation.
And are the rents in this building? So I would have to go back to your page, but are the rents relatively uniform, or are they very diverse, reflecting perhaps motivations and other factors?
They are relatively diverse, but I think that's more a result of the fact that those rents, most of the rents are semi-gross or gross. So you have to be very careful about what deductions you're making from the semi-gross or gross rent. And I've tried my best to do that. I mean, I think Altus is pretty careful. We have calculation sheets where we look at the expenses over a number of years and try and determine what the appropriate deduction. But you will have slight variance. But the point being is I took the extra step in this case, Mr. Chairman, to test it to rents attained in similar buildings. And my conclusion was, yes, we're pretty bang on. What's happening at the property is bang on with the market. And what is happening with all the properties is that those rents are declining because of all the factors I mentioned happening in the reference date.
Okay. And what is the specific rent that you used in your calculation? I note, and this is a common in your presentations, on page 23, where you provide that very nice chart with everything summarized, but you never list the actual rent that is being used. We also have a very nice spreadsheet that we as members make use of, and we put in the city's info and the applicant's info, and we always have to go and calculate what your actual rent is, because we might wind up debating what is the best rent to use.
Yes.
What is it in this case?
Yeah, so that's a great question, Mr. Chairman, because on page 23, I typically like to put beside the PNMI, that 1,926,000, what it is per square foot. But if you back up to page 19,
yep,
you'll see how I calculate that number exactly. And so you'll see all of the rents applied to each of the units. So we look at each one and we determine, are we using actual? Do we go to market? And we go down the whole way, and then the blended rent over all the units is $10.99 a square foot, which gives us the 1,926,000.
All right. I just wasn't sure if that was exactly what's being used. Sometimes people will have a line after that kind of a chart saying,
yes,
therefore we've used 10.99, and it's just a tad clear.
Yes.
Okay.
Thank you.
That's all my questions.
May I have a follow-up question?
Yes.
So one point I missed, and pretty glaringly, obviously there's a higher degree of vacancy. You have access to the Johnson report. You use it every year. What are they advertising? I didn't see any advertisement for this property. What are they advertising in the marketplace? There's ads for other properties that you have in your briefs. What's the property owner feel that their space is being advertised as?
Well, I mentioned that. I interviewed the owner about what they were asking, and they're asking $10.75 per square foot on a net basis. They don't always attain net. They prefer that. On a gross basis, they might get something like 18 to 20, but on a net basis, they'd like 1075. But he said, we never get that.
Okay.
And, the best example that he had was the most recent net rent was at $9.
Okay, so who are they advertising with? What brokers are they advertising with? Because usually when you canvass, you'll be able to find, especially for a degree of vacancy for as long as this has been. And I didn't find anything.
Yeah, I'm not sure, Mr. Poole. I'm not sure which broker it is, but they're not, nobody wants vacancy. Nobody just sits and waits for the tenant to
Did you
come.
yourself look at the Johnson report and see what they're advertising in the Johnson report? Which is
No,
just
I don't rely on secondary information when I have primary information at my fingertips.
Some of the questions I have. Thank you.
Okay, thank you. Well, then that concludes 311 Portage Avenue. That was 311, right? Not 251? Where are we? Hang on.
We're at 311. Portage Avenue.
We're at 311. Yeah, all right. Make sure that my notes.
And
We're up.
just so the chairman knows and the panel knows, this is a OFA. It'll be more a larger appeal, obviously, to speak to, but the remainder and the rest of the docket are fairly straightforward properties. So they should go quick.
311 onward.
After 311. 311 is a class A, you were class A, so it'll take a bit more, but the remainder of the afternoon. Should go quick.
Okay. So then next up is 311. Do you want Mr. Poole to do that before a lunch break or after?
Well, that's what I was getting at. I don't see it getting through it any more than maybe 45 minutes to an hour.
Okay.
Would that be reasonable, Rod? What do you think?
Yeah, I think, Jeremy, again, I made a revision to my valuation, so I've narrowed the issues. So
You did that as well?
Yep.
I haven't.
Okay. Well, then let's proceed with 311. Just give us a moment to bring it up. We have 3 items here. And unfortunately, for some reason, I cannot open each of these columns wider. So we've got 311 showing up 3 times. Sally, what have we got in these 3 different items?
The first one should be the assessment and taxation brief. The second is the assessment and taxation study. And the third is the applicant brief.
All right. Well, then we start presumably with the brief.
All right.
Yes. Proceed.
22, file number 221757. Roll number is 130990688870. Civic address is 311 Portage. The 2023 assessment is for $32,338,000. Built in 2015, so it's a newer OFA. Leasable area is for 103,441 square feet. There is no indoor parking on this roll, but it's combined with the greater building with various parking. So if we look on page 2 is where it's located, right across from New Canada Life, Reading Canada Life Center. Page 3 is the photo of the property. As you can see, I don't think there's any indication that it's not a class A. It's an A prime, in my opinion. When you look at the write-up on page 4, it consists of 2 restaurants, office space, and they also have a Tim's in there as well. So highlighted in yellow, the building was designed to high environmental standards, accommodating the health and wellness of staff, visitors, tenants. Sustainable features include interior lighting wells to maximize daylight, low energy lighting, low consumption plumbing fixtures, energy efficient heat pumps, recycle, and low volatile organelle compound materials and building materials. We'll go through this further, you can see the pictures. We had, it's occupied primarily by Stantec, IQ Matrix. As you go through, you see where the tenancies are. So it's a very nice building. If you go through the pages, I haven't been in the building as far as an inspection as the office area, but I have been in the grounds quite a few times. I haven't been in the restaurant as far as the merchant's kitchen. We prefer merchant kitchen, but it's always busy. I can't get in. We go there before the check-in, but for after and I don't know how you get into there, but I get beat into there every time. So, anyways, so Stantec, as you can see, it's interior. Obviously, Stantec is what they are. Fully aware that they were involved with the design of the building, and then they occupied the building. They won an award for the design itself. So as you can see at the top of page 10, so their office space, which is the predominant office, is phenomenal. As you can see from the pictures, very much akin to what you would expect in a prime. So as we go through them, you just get a good feel for their property, all high in space until you get to on page 23, which is the restaurant areas. 23 is the merchant kitchen. And again, I've never been in it. I looked through the window and went, the line is always way too long, but they just full. You can't get in. So, and then you go to page 25, which is Brown Social House, which you can pretty much always get into. And then there's also Tim's as well embedded between the two. If you look at page 28, just to lead up on what I was speaking to, it is LEED Gold certification for their Stantec building, which primarily is the entirety of the office space. So it is LEED Gold, similar to True North. True North is also LEED Gold. So what that essentially states is that you're expecting to get a lower cost for occupancy as far as costs for your tenant that would have to pay. So on the effective market rent, you would be able to get a higher degree of effective market rent. So if you have cost assurances to your tenant, you know, all things being equal, nothing comes for free, you'll be able to get a higher net effective rent. And that's what you see playing out here. So before we get to the work of itself, let's go to the study. Sorry, not the study, the INEs. This will answer a little bit here as far as how the study goes up here. So when we go through, starting on page 37, we can start at. We can see on page 39, it states that all tenants are net tenants. When you do the math on the actual reported fees, monthly rent, I should say, as far as leaseable areas, they are higher than what's been reported in other years. So I think there's been an error here, but I have looked at all 6 years. So you look at and that's just on page 39. If you actually do the numerical math on the reported monthly rents times 12 and then divide by the areas, it shows are higher than what is on page 41. So 41 is correct. That's the actual rental rate. So I don't know who's filling that out. So that's the only year that shows up like that. So, but they are confirmed that it is net rent. So as you can see highlighted in yellow, the areas of the building, what the rental rates are, and that's reflected in my study. We'll see that in a moment once we get to it. But what does change throughout the years is how they show the rents. The rents, as you can see, for Brown's and Tim's and Merchant Kitchen, they all stay relatively the same as far as areas. They are the same. But as far as areas, as far as iMatrix and Stantec, they change with the remeasurement of the building as you go through, and then they lump the Stantec CRUs into one and then they break them out again. So it looks like there's more rents that are in there, but we're just being reflective of what's actually being reported to us. So as you go through the rent rolls, hopefully that answers the agent's question as other appeals that came up. So when we get through that, you can see the rents all highlighted for all years, highlighted in yellow for your reference. On page 47 is a breakdown for as far as the restaurants for the area, included in yellow, the subject properties. So this is for the Shed District and just downtown in general. And as you can see, for Brown Social House, they're at $35. Russian Kitchen at $30 and Tim Hortons at $28.50. As well as Tavern, Shark Club, Boston Pizza, Marcello's Market and Deli, which is a little lesser than, and then Rudy's Eat and Drink, they don't report than the last year. So, and then the RSDs for as far as downtown, the restaurant for downtown, a little less effective rent, but still hovering around the $30 mark, with a few a little lower than that. But again, not in the shed district. So, you look at page 48, which again, True North is greater than this building. But this is the next best, in my opinion, building, which is numerous similar LEED Gold. You see the rents here in place, and they're hovering around $30, triple that. So again, this building is a step down from True North, but all things being equal, it is the next building closest to this. If you factor out the hydro building, which is owner occupied, it's a different animal altogether. If you look at page 49. You can see highlighted in yellow, 311 Portage. They're advertising $24 a square foot to get into the building, and CAM at $15. So you can see that the operating expenses is what I was getting at, is much more efficient for what you get. So you effectively get a higher net rent if you can look at it in those terms. So, so from that, let's get to do a marketplace study. And again, I'll trust that you'll read the entirety of the commentary and we don't have to focus on that. But my view here is this is the best market evidence to come to a fee simple analysis of the property that minimizes tenant inducements and so forth, and gives a true reflection of what the marketplace is on a stabilized basis leading up to the reference date. And here's a good example as what I was indicating how to use it as far as page 4. The chart that you see as far as the global marketplace, again, 2020, $19.
Sorry, you're asking us to turn to your report. Is that correct?
To the OFA marketplace study. Yes.
Okay. Just a second.
So we're all there on page 4. You have a weighted average in 2020 at $19.94 for the entirety of the OFA marketplace. You have a stabilized for 2018 to 2020 of $19.21. Again, vacancy as well. And I'll talk to the vacancy at 16.4% as far as stabilized, and 20.3% as far as the actual. Those two things, we made adjustments downward because as we looked, the vacancy as reported to us is unoccupied space within the building. But in any Class A building, and majority of Class A, there's already spoken for space, committed spaces that you're waiting to get a tenant into, that being withheld from market. So I'll show you that out on page when we get to the vacancy portion of the Johnson report, which is more reflective of the scene, which actual spaces are advertised to the marketplace where they're in need of tenancy. So shortfall again, $19.32 in contrast to the subject property. I'll get to that in a moment. And then non-recoverable weighted average at 2.6% stabilized.
Sorry, your shortfall average. You're using what figure?
Stabilized $19.32 for the 2020 year. It's $19.31. But again, we're going to look at what the marketplace is and also what the subject property is. So
you're back to your brief. Sorry, I'm looking at your page 4 of your study.
Yeah, and I'll get to the actual subject property, which is in the study. So I'll get to that as well as the advertising of the property as well. So non-recoverables, again, as we spoke to, hovering about 2.6% for both years for stabilized and for 2020. The chart that you see below, or graph I should say that you see below, is again, when you step outside of.
I'm sorry to stop you again, but I'm not seeing 2.6%. Where do I find that?
Well, non-recoverables.
Yeah.
Fourth grouping down. 2020 year, it's 2.6%. And you stabilize, which is 2.6% as well.
Non-recoverable average.
Yeah. Weighted
Or
average.
stabilized, weighted average, okay, stabilized, I see 3%. Am I looking in the wrong place?
Are you looking at the OFB study or are you looking at the OFA study?
Oh, I'm on the OFB. And OFA is the different document. Sorry, but the problem is the first column in the docket does not open beyond a few words. So I've got to guess as to what I'm opening.
Okay. So obviously they're different classes, and that's why I broke them out. And realistically, the reason why I did the A's and B's, and very realistically, that's a lot of work there. I couldn't do the C's as well. There's only so much of me to go around. So we did the OFA and B's. I'll be looking to do the C at some point in time. And I'm not sure if we'll get to the D's or not, but we'll stop at that. So this gives a good synopsis of the marketplace itself as far as investment properties, which are really the high grade level properties are B's and upwards. Not saying that some C's aren't really good performers as well. So overall, as you can see, the numbers are stabilized in the very left column that's bolded, or right column that's bolded, I should say, and then your 2020 year. And you can look at it every individual year you want. So again, hopefully non-recoverable average is 2.6%. When we look at the graph, and the chart underneath the graph, this is where I want to point out, this is a proper statistical study done with 1 standard deviation, 2 standard deviations, and of course in red would be your 3rd standard deviation, which would be your 95% comparable, your outliers. You shouldn't be looking at that per se, but what you should be looking at is what the subject property is performing at, what the marketplace is, and doing a reconciliation between the two. So we see that the average median, I should say, is $19.21 for the stabilized. Again, $19.24 for the 2020 year. So you figure on an average one, you'd be about there. This is beyond average. This is greater than that. So how do you use this chart, use this graph or board to judge how it performs? Well, one of the good indication is to go into the actual subject property and see how it's performing. If you see what we assessed for as far as rent in the property, and none of the series that we out for that, maybe that's a good indicator that we're off. Or if you see what the marketplace is in this case, at hovering around $20, and you see none of the rents that are in place in the building at that, they're all greater than that. It's a good indicator that it's better than the performing property. So when we go to the actual property on page 6, and you can see, which is the last comparable, 311, for all of the years. And again, this is reflective of what's being reported to us. Some of the CRUs change for individual CRUs, and then they lumped them all together, and they were just reflective of what's actually occurring in the property in an individual year. So as you go through, you see for the subject property in 2015, when it initiated, their weighted average is $22.90, and then $23.05, and then 17, $22.82. And then in 2018, they don't report, or I didn't find that in INE anyways. I'm not sure if they reported or not. I'm not going to get them whether they did or didn't. So that year is missing. And then you look at 2019, it's $24.25. 2020 is $23.92 for a stabilized $24.06. So getting back to the study, you're about $4 higher than the actual average. Nowhere in there do you see a $19 rent. So it's a good indicator that this is performing better than the marketplace, as you would expect, because it's a newer building, more efficient building. You're going to get a greater rent. So the $24.06 is very reasonable. It's what you would see. So this is a good way of looking at how the study performs. What's average, what's below average, what's greater than average. This is a better than performing property. So it's at an A prime in my view. When we look at the vacancy, again, your vacancy is obviously startup vacancy at 21.3%. The building inception was 2015. It drops to 11.5% and then 0% as we move forward. So, and this is just the office place. This excludes the 3 restaurants in the main floor. So when we look at the Johnson report, You see for 2015, what they're advertising their vacancy and what their shortfall is. Their shortfall is $15. So again, then it drops from 15 to 16, 10% for vacancy. They're still advertising $24 as they have. And then 2017, it's a zero vacancy. And for whatever reason, the Johnson report still advertised at $24. If there's no vacancy, I'm pretty sure they didn't put out any advertisement for the property, but I guess the Johnson report keeps reporting that. So as you can see, there's no vacancy throughout the rest of it, and the shortfall was at $15, and their opinion of value is $24. So it's right on what they're actually getting. So let's go to how we've assessed it. That's starting on page 31. So I've broken this out on page 31 for the office area. The average office area that we have for rent is $22.21. You can see it's functioning or performing at a $24 level. So again, I think we're being conservative even for an AOA prime. They're at around $24. We're at $22.21. Marketplace is about $20. It's better than market, or better. It's at the higher end of the what marketplace, obviously. As far as the restaurant, it's at $29.55 as far as assessment wise. And if you go back to page 47, you see highlighted they're at $35 for Browns. They're in at $30 for the merchant kitchen and $28.50 for the Tim's. So again, conservative considering how the building is performing. We move on from that point. It produces a potential rent of $2,303 for the 103,441 square feet. And again, we put on a 10% vacancy. The reason why we chose a 10% vacancy as far as what the study says is exactly that. Like when you look at what's being reported, and it speaks to as far as vacancy on page 3 of the commentary. What we found is the actual advertisement for each of these buildings, as you go through the Johnson report, is less than what's being reported on the INES as far as tenants that are on tenanted areas that are non-occupied. So when you go through the vacancy rates within the building, 200 grand is a good example. They were experiencing some vacancy. They're reflective of that. But as you go through the rest of it, what we have reported is lesser than. So I should say the Johnson report advertises lesser than what we have reported. So from that point, we move back to using a 10% vacancy because you have to be marketing your spaces, you have to be advertising it. If you have commitments that are in place, because you're Class A office building and there's a list of tenancies waiting to get in, you don't have the risk. If you have a full amount of space that's unoccupied, you should be advertising it. And if you're not, it's usually because there's commitments to those spaces. So whether they be through already existing CRUs the way they are, and they're simply listing it in, or they're amalgamating spaces within the building to get tenancies to move into the building, which did occur quite a bit in the marketplace and leading up to it. So from that, I think 10% vacancy is appropriate. So that gives you a effective gross income of $2,160,273. Our expenses at 3%, which is just under the 2.6, or just over the 2.6%, which was proven. The shortfall at $15 gives a net operating income of $1,940,303, and capped at 6% gives a value of $32,338,000, roughly rounded. So with that, I think it's a very fair assessment for an exception. So I'm open to questions.
Mr. Slaughter?
Thank you, Mr. Chairman. Mr. Pohl, I'm going to start with page 49 of your direct evidence. You, in many presentations, you seem to put a lot of weight on Johnson report that may contradict actual evidence as provided by the owner. Now, on page 49, you show that Johnson report is advertised or states that there's space being advertised for lease in the subject property in 2020, correct?
I believe there was a subtenancy, if I'm not correct, that they were advertising, but aside from that, I didn't find anything else.
You'd agree, well, the subtenancy is an 80,000 feet, so you'd agree that this is probably incorrect?
No, that's the rentable area. If you look at the vacancy reported, like I highlighted before, there is no area for the vacancy. So they're reporting.
You only list this if there's vacant space being advertised, correct?
As I indicated, as I spoke to, as far as discrepancy or vacancy or within the marketplace or even the subject property, for as far as this report and what we get on the INEs. According to this Johnson report, there is zero vacancy. There is rentable area with zero vacancy associated as far as rentable area being listed. That's why I question why you would have an actual asking rent in that year. What most likely happened is during the startup phase, that was the rent that was in place, and the report just continues on with that rent. So
now you're correct that there was some subleasing because Stantec had downsized, or was planning on downsizing. They may have been advertising for that in advance, but I don't think at that time they would have. Okay, second question, your study, and I won't ask you to turn to this, but just to reiterate, your study of the office market indicated a non-recovered allowance averaging about 2.3%. To confirm.
2.3% for the average, but I do the weighted average and the median as well. I rely more heavily on the weighted average simply because it's more reflective of the space that's being occupied within the marketplace. There's a couple properties that are a lot larger OFAs than other ones. So,
okay, but just to confirm something mentioned earlier, that doesn't include the largest items of space marketing costs, leasing commissions, tenant improvements, correct?
As indicated on the rent, I've excluded all of that. If you look at page 2, gives a good indication underneath rent what's being excluded. Tenant improvements, leasing commissions, leasing incentives shouldn't be used. So that's what's redacted out.
Okay, thanks. Page 10. So you're mentioning that this property had won awards. Many offices win awards for their design and build efficiencies.
Main brief, page 10.
Page 10 of your main brief, yeah. Now, it was Stantec that won this award. You're aware that Stantec designed and built this property,
Yes.
correct?
Yes.
Yeah. And Stantec is the majority tenant in the building, correct?
Yes.
Would you agree that that's a non-arm's length lease?
Not until I see a document from the property owner and from Stantec indicating that it is non-arm's length and somehow there was some consideration given to the rents that are in place. Until I see that, I'm not going to be putting any weight to that.
Okay. I won't ask the panel to turn to this, but just to mention again, you had a second standard deviation in your bell curve of market rents in the market.
Yes.
And you mentioned if a rent is outside, if it's below that second standard deviation, for example, you'd say, well, that's probably not at market.
No, let me be clear. Like I'm trying to make it as easy as to use. If it's an average building, it should be roughly at the average. And one way that you look at that is check to see what the rent roll is. Right? We shouldn't be doing either one in isolation. So when you see a property that you do the analysis on, it's hovering around $24 and you see the marketplace inclusive of that at just under 20 or just over 19 if you look at the stabilized. Okay, it's greater than what the average in the marketplace is doing. Let's look to the rent roll. Do you see any rents at 19? No. Do you see any at 20? No. You see them hovering around at the reference $24. Yes. So you see that all of those rents are greater than the average, which would indicate a better performing building. The exact same way as when I looked at a property, say, and it's at we're using A's, it's hovering around $19, $20 as far as the average. And I see a property only producing at 17 or some 16s or something. Okay, this is hovering below that, the rent roll indicates. And if I look at that property and I don't see a $19 or $20 rent in it at all, okay, that's a good indicator that it's a lower performing A, and I quote lower performing A because they're all well performing properties, but that's why they're A's. So that's a good way of looking at it. You can't just look at it in isolation. So in this case here, we see a property that all of the rents are greater than the average, and you would expect that. It's a newer building, it's a more efficient building. That's right what you would think.
So just to be clear about that, and what you're saying is, and I agree with you, I mean, you can look at all the rents in the marketplace and put them into a nice bell curve, but at the end of the day, you got to look at what's actually happening at the property. And you mentioned that if something is outside of your second standard deviation, I mean, that's outside, that is a rarity. And so let's take the hypothetical example. We have a market rent that is below your second standard deviation. And you look to that property and that rent is questionable, whether or not it's arm's length. I'm not saying it is or isn't, but it's questionable. Is your opinion solid that is market?
Can you rephrase that or repeat that? Are you saying, just bear with me for 1 second. Are you saying because if you look in red, the 4 CRUs that are outside of the second standard, those are the ones we're talking about, right?
Yeah, and okay, one other question before that. We recognize that the subject property has 5 leases. 3 are restaurants.
I'm not including the restaurants in inclusive of this. They're not
okay.
I'm valuing them independently with independent comparables. They're not
Right.
inclusive of this, of the office stock of CRUs. It wouldn't be appropriate to put them in.
Let's put it this way. You agree that the Stantec rent is far beyond the second standard deviation upper limit of rents in Winnipeg. And you also agree that Stantec, the tenant, also designed and built the building.
I didn't disagree with that. As far as the upper limit of the second, grouping, second standard deviation, it's at 2250 as far as where market is. We see the subject property at about $24.25. It is greater than, but you would have to be looking at that with good reason. Same way as if you look at it and if it was on the opposite end of the spectrum or it's significantly low, there must be a reason for that outlier. Maybe it's far poor space within a good performing building, could be, or maybe there's tenant inducements involved, which would lower that rent. So in this case here, when we're looking at a $24.25 factor around there.
Sorry, did you say tenant inducements would lower the rent? Did you say, is that what you said?
Yes, my opinion is, and as I'm going through these leases, that if you have an anchor tenant come in and pay for the improvement of the spaces, you get a reduction in the rent, and that would secure that tenancy with the lifetime of an anchor tenant. So I know you have a disagreement with that, but
yeah. So rents that are inflated by the owner's investment and amortizing the rent, that's normal. But if the owner doesn't put money in, then that's abnormal.
Again, I'm just trying to answer your first question, if I can answer that.
Sure.
So what you're saying is, should I not take a more look at the $24 rent that's in place in the series for the 4 series? Yes, and I did. And you would expect that, and I proved that out. As you see in the rent roll, they're all where they are. They don't have a $19 rent in this building. They don't have a $20 rent in this building. They have rents that are hovering at approximately hovering at just over $24 stabilized, and they're advertising that as well. So it's lining up with a prime newer building that is more efficient, and you pay less per cost, which would mean from a tenant's perspective, you'd be able to get a higher rent.
Right. And again, 3 out of 5 of those rents, 3 out of 5 of those rents are restaurant, main floor restaurant rents.
No, Mr. Slaughter, I haven't included one restaurant rent in this.
So there's two rents that you're looking at.
Yes, and
one is standard.
As I indicated, if you go through the 5 years of INEs that I provided, because they don't have the 2019 INE, they're being reflective of what's being reported to us.
Okay.
That's why
so
you see the difference.
Yeah, so we've got 2 rents, one questionable between the relationship of the builder and the tenant.
No, in my eyes, it's not questionable until you provide documents saying that they are not arm's length, and somehow the explanation as to why would be signed off on either Stantec or by the owners, and then we can look at that. I don't see that. So
notwithstanding that, it seems a big part of this valuation is based on your opinion that this is, I think you called it an A prime building. Let's talk about that for a moment.
Sure.
When this building first came on the roll in 2015, it would have been the modelers who set up the assessment, correct?
Mm-hmm.
And they had classified this as a B, correct?
I believe so, yes.
And for the 2023 assessment, this assessment now, for the first time, it was you, I think, Mr. Bull, who overrode that and called it an A. Is that correct?
I did.
Yep. And your reasoning is that the building is more efficient and it's newer than a lot of the other A's. Is that correct?
Not just that, but let me go into it in full. I looked at it and went, how did this ever be a B? I was unsure. So at that point, I reviewed it. I reviewed the performance of the building as far as incomes as far as obviously the characteristics of the building, a lead goal, everything that's inclusive of it. And going through my study, not only did I change it to an A, but so did the Johnson report. They had it as a B as well. I think what happened was, from our perspective, we only looked at the office complex, where it's obviously the larger portion. So it's what it is. But on all aspects, this is a high-end A. It's not at the level of, as I indicated, True North. That is a different animal altogether, but it's probably the next best renting property to True North.
So let's talk a bit about the characteristics of a Class A building. Have you ever reviewed, say, BOMA standards on what constitutes an A or a B?
Yeah, I don't have them in front of me or inclusive in my brief, but obviously newer building, higher efficiency building, parking location, both of them have it here. Downtown.
Yep. Okay. So those are two characteristics, or some of the characteristics. The other Class A buildings in town that you have in your study, Richardson Building, 201 Portage, 360 Main, these are all over 30-story towers, correct?
Yeah.
And then the last two would be 400 St. Mary and 200 Graham, and those are 11-story towers, correct?
Yeah.
And how many stories is the subject property?
Subject property, if you look at just the office component, is 6.
6. And the number one criteria when you look at the BOMA classification, you'd agree, is a high-rise building in a prime central location.
Correct.
It's the very first criteria.
Are you looking at this in isolation to just what we have individually on one roll? Or are you looking at the entire complex?
I'm looking at there are some characteristics that I agree that fit into an A category, and there are some that.
So if we would put everything on one roll, then you would have no issue. We just, for our assessment purposes, we put it on one roll to isolate the restaurant and office component.
As far as location, you'd agree that all Class A's are connected to the walkways or concourse. Is the subject property connected to walkways or concourse?
It's connected to go to the parking lot, or parkade, I should say.
Is it connected to the walkways or concourse?
No, it's not connected to
No, it's not connected at all. The parking that it is connected to, is it heated parking?
No, it's outdoor parking.
It's outdoor parking. And does the property have amenities on site besides restaurants? Does it have, and these are listed in the BOMA standard for Class A, does it have conference center, fitness center, convenience store, dry cleaning services, food court?
I didn't get into the other components of the building, but obviously Stantec is a good employer. Whether they have a gym area, I'm not sure. Could there be a gym area? They could put it in if they wanted to. That's more the tenant, what the tenant wanted.
That would be the tenant. Yeah, that's all the questions, Mr. Chairman. Thank you.
Ms. Davidson, questions?
I have no questions. Thank you.
Mr. Dunjal?
I have no questions. Thank you.
I got a very basic question and sort of gnawing concern, and that is about this building. And I'm going to use a term, Mr. Pohl, that might be a little odd to you, but I'm going to use the term roll entry as opposed to roll number. A roll entry being the entity that has been put on the roll and there is a number associated with it.
Yeah.
So this is a 6-story office building.
If you turn to page 3, it is a good example.
Just a minute. Page 3, yes. So this is a 6-story office building, and your roll entry includes the office portion and 3 restaurants.
Yes.
Now, the main floor, correct me if I'm wrong, am I right in understanding that the one restaurant, Market something or other, is at the extreme north end? Then there is...
Portage. If you look at it street side Portage, it's Brown's.
Yeah.
And then if you walk around, you run into Tim's. And then you walk further than that, you'd have Merchant Kitchen.
Is it not correct that in between Tim Hortons and Merchant Kitchen is actually a lobby for the hotel?
Oh yeah, no, yeah.
Right.
That's why I was.
And then there's the hotel. There's a hotel above.
Yes. Yes.
All right. So you've essentially created a roll entry that that constitutes the office portion, and ignores the main floor part devoted to the hotel and the hotel tower above the
As well
Stantec
as the parkade being excluded too.
and the parkade. Okay. So my next question is, who is 310 Donald? Is it another name for Stantec?
I did do a company search on that. I can't imagine it if Rod, if you're saying that Stantec owns the building.
No, no, I didn't say that. And
However-
Mr. Chairman, do you want me to answer that question to jump ahead, or?
Yes, if you don't mind.
It's not Stantec, no.
It is not Stantec that owns it. Okay. 310 Donald, however, owns everything, and this roll entry owns the parkade, which is a separate roll entry, and owns the hotel, which is a third roll entry. Is that correct?
Mr. Paul, would you like me to answer that?
Sure, I wasn't sure who you're asking.
From my understanding, Mr. Chairman, they own the parkade and the tower, and you'll see on the financial statements that those two are combined as one economic unit. I do not believe they own the hotel, although it was part of the original, as you described exactly, part of the original design.
So 310 does not own the hotel part of this building.
I don't believe so. I could be wrong. I think it's air
Well,
rights.
I guess this question is formally for Mr. Paul, but then if he can't answer it, secondarily for you. What would get sold here? Like, we in doing coming up with our value have to mimic the market. And that means we've got to make an assumption about who the buyer is. We've got to know specifically who the seller is. And we got to understand what would get sold. So are you saying, Mr. Paul, that the likely thing to happen in the marketplace is that the Stantec leased portion, the Browns, the Tim Hortons, and the Merchant Kitchen would get sold exclusive of the parkade and the hotel above?
I'm just doing an evaluation for the obviously the office and the restaurants. As far as different ownership between the two, I didn't research the alt hotel, whether there's a separate certificate of title where you could separate some separately or multiple ones. I'm not, maybe there's multiple, but I mean, assuming there's two, you'd be able to sell either one individually. And given the fact that there's different ownership between the two, I think that'd have to be at least that circumstance. But as far as just putting an assessment on the property, we're looking at just the office and just the restaurant. But I think what happened in as far as classing it at Class A, you look at the entirety of the complex. That's what the Johnson report would have done. They're not going to break it up until we've broken it up for assessment purposes. But when I looked at it, it was quite obvious that this was an A property and not a B.
Okay, I'm not questioning whether it's A or B. I'm wondering why this total property is not done with three income streams: restaurants, office portion, and hotel.
So you're wondering why the rest of the incomes is not associated with this roll number. We just make one roll number for everything.
You're getting that? In part, yes. That would
we have some properties that have multiple roll numbers. As far as that aspect, I don't think that really comes into play because we're valuing it separately and distinctly. Just so we're clear, the office study, as far as OFA, has just offices in it. I did not include the three restaurant areas.
Yeah. But
so,
here's my concern. My concern is that, like you, we have to put a market value on the property. So we've got to know what would be marketed. And I question sometimes the city's practice of what they put into a specific roll entry, because it strikes me that this would be sold as a total entity unless what you're saying is that the hotel has air rights and the air rights would be sold separately. Is that the case?
Okay, first of all, part of this is discovery. I do not and have no affiliation with multifamily. I didn't look into the valuation of that at all. I'm just finding out that it's not common ownership throughout. So if there is air rights involved, similar to 299 Fort and 360 Main, there would obviously be a fee paid for that air rights, which would be attributable. There's municipal board orders on that, but I didn't research that aspect of it. I don't know about the multifamily rule. I've never had it under appeal. I've never had a question. I believe this is the first time this property's gone to appeal. far as part of
Okay.
the office portion. So from my valuation perspective, if we're looking at just the office component, we would just be looking at the office component, the restaurant component, obviously. But if there's any associated, there's any associated rental income coming in from the air rights, that would be inclusive of it. Add that to it. But at the same time, as 299 360 main order indicated, you'd have to take that off of the property as an expense. In this case here, I don't have that information. I didn't go into that. So
Okay. All right, well, that's all my questions then. Mr. Slaughter.
Thank you, Mr. Chairman. First off, I do have a revision to our valuation. If the secretary wouldn't mind forwarding on that new valuation sheet for the panel.
They already have it?
Okay, great. So, Mr. Chairman, I'm going to keep this short.
Well, hang on, wait for us to get to that.
Certainly.
And is that Sally, is that the fourth item down that begins with 311 Portage?
Yes.
All right. Okay, got it. Go on, Mr. Slaughter.
Okay, so if you could have that maybe on the side, and I'll just ask the panel to go to the direct evidence that Altus provided, and I'll just move through this very quickly. Is everyone good with that?
Just a second.
Sure.
All right.
So on page 6, if you don't mind turning to that page, we've got some photographs. I think the panel is well aware of the property, and again, what we're focused on for today's valuation is just the office component. The parkade is separately assessed, the hotel is separately assessed, and the residential section is separately assessed. We basically have 3 main floor restaurant tenants and Stantec, who designed and built the building, as the predominant tenant. There is 1 floor that they don't occupy that was subsequently leased to a company called IQ Matrix, call center company, I believe. I'm going to cut to the chase on the market rents, Mr. Chairman. What we've done in the end is that we had a concern about the relationship of designing and building the building and then subsequently entering a lease, especially when the lease is, in our opinion, far above market for 70,000 square feet. At the reference date, I don't know if it's known, but as Mr. Pohl said, there is some subtenancy going on because Stantec has downsized their space. And the owner is concerned because they don't know if these rents are sustainable into the future. Now, when we looked at the market rents, we felt that the restaurant rents were fair. They were at market. It made sense, especially for that location right across from the Canada Life Center. But through the pandemic, and this was communicated in the questionnaires that the city had submitted to the owners, the COVID questionnaire is called, they said they have impact from the pandemic. They have deferrals from these restaurants. The restaurants can't keep up on their rent, and they have concerns about a few of them. Then we have Stantec. I mentioned that lease. And then we have IQ Matrix, who is an arm's length tenant. But just so the board is aware that the owner had to put in $30 per square foot of improvement allowance amortized into that rent. We're not asking you to deduct it. We're just trying to give some context about the rents in place at this property. So in the end, I had a bit of a concern with the rent, and I did a market analysis on only the Stantec one, and the rest I accepted as market. And we were a little bit lower, but not enough, Mr. Chairman, that at the end of the day, I felt that was a major concern. And so what we did is I had a change of opinion. I decided to accept the city's rent that they've applied. So it's a higher than market rent, but again, the arm's length tenant suggests that although there were tenant inducements, that seems to be the appropriate rent. There are things about this property I agree with Mr. Pohl. It is a very efficient building. It has above normal mechanical systems. It has a ground loop system, a geothermal system, which is shared actually amongst the parkade, the hotel, and the office tower. That also could be seen as a bit of a risk for anybody purchasing just the office tower. But in any event, it's an efficient building. That's one quality. The fact is, and this was especially brought out in discussions interviewing the owner about their concerns about the property, it is not connected to the walkways or concourse. It's isolated. And it doesn't have on-site amenities. And these are things that tenants who expect in a Class A building are going to look at and consider. And this is a bit of a concern for the owner. The parking that they're connected to is above ground, unheated only. There isn't any other Class A building in town that doesn't have connection to underground heated parking. That's a second concern. Its location, although, theoretically good for the restaurants, being across from Canada Life, has been described as problematic by the owners. For example, Brown Social House, who has a kind of a patio on Portage Avenue, they're now having to invest in doubling the height of the glass partition because of the amount of people who walk by and reach over and have grabbed people's food off their plate. It's been a bit of a problem location for them, the hotel, and the parkade. Long story short, Mr. Chairman, if this is an A, I can only think of two characteristics of many that would substantiate that classification. I don't necessarily think this is a B, but if it was an A, it would be at the lowest end of the category for Winnipeg downtown office. So I'm going to jump ahead here to right to the main point, which is the capitalization rate. And it's more of just a verbal argument. I won't go back to the capitalization rate study unless the board would like me to. But the conclusion was last cycle, we were arguing for 6.25% on the Class A towers. And we feel that the capitalization rates have only increased since April 18 to April 21 for reasons I discussed earlier today. That would give us a base Class A cap rate of at least 6.25%, if not higher. If this were a Class B, the city would apply 6.75%, we would apply 7%. It's quite a drastic difference. And this property, to me, does not have the characteristics to make it jump from a B cleanly into an A. It falls somewhere in between, in my opinion. And for that reason, I don't think a capitalization rate any less than 6.25% is appropriate for the subject property. That's the number one concern. And the second is, as with all downtown office, Altus is adamant that we recognize non-recovered expenses that seem to have just disappeared in the valuations. And so we ask that 7% again be applied as the non-recovered allowance in this property. Just for the panel's reference, I didn't mention something earlier, that when we do our calculations on cap rates, we are consistent. We use 7%, we adjust vacancy, et cetera, et cetera. If we didn't use 7% and we use the city's 3%, our capitalization rates that we determine would be about 28 basis points higher. So if we say a cap rate should be 7%, if not for the 7% non-recovered allowance, that capitalization rate would actually be 7.25%. So the way we usually ask the board to consider it is this. We think there's pretty sound evidence to support the 7% non-recovered allowance. But should the board decide that, no, we're going to stay with the city's NOI and the 3% expense allowance, we then would ask for 25 basis points higher on the cap rate, which would be 6.5%. In any event, Mr. Chairman, on the revised valuation sheet that if I could ask the panel now to turn to. The only two differences between Altus and the city at this point is with the non-recovered allowance and the capitalization rate. And I think those two are in blue on that revised sheet. Everything else is
using, sorry to interrupt. You're using what rent?
The rent that we're now agreeing to the city's rent, which is close to the actuals anyway. And it is, sorry, just find that. Blended 22.21 a square foot. Oh, no, sorry. That's just the office. And the restaurant's at 29. So sorry, Mr. Chairman, I'll do the math here. $2,403,003 is the total, divided by 103,441. Sorry, Mr. Chairman, my calculator on my phone seems to have disappeared too, so I'm just doing the calculation here. It's $23.20 a square foot blended.
Good, thank you.
It's in my brief on page 31, if you want the breakdowns for the office and the rent and the overall.
And so that's the only two differences, Mr. Chairman, and that concludes our presentation.
Mr. Pohl, questions?
Okay, just part of this discovery, obviously, first off, is there air rights here, and is there any rent being paid by the ownership group of the hotel to the office, the ownership of the office restaurants?
The registered owner of the hotel is different. That's all I know, Mr. Pohl. I don't know of any leases. I don't think there's any leases, or we'd see it on the financial statements.
Yeah, and that's where I was going with it, because on page 30, you can go through yours or mine, but on page 37 of mine is what they actually give, they fill out the INE in lieu of, which usually is a financial statement. They fill out our INE, they put it in, but they're including all of the components of the building, the hotel, the parquet, the office, the restaurant, correct?
Possibly. I don't think the hotel is part of that, though. I think it's just the parkade and the tower and the restaurants.
Which would, part of this is obviously we're agreeing on rent, it's just the cap and it's just the non-recoverable.
Yeah.
They don't report non-recoverables. And of course, they're doing the other income streams as well. Did you investigate with the property owner, given the efficiency of the building, what the actual non-recoverables are?
No, but I do know that, well, for example, IQ Matrix, I mentioned they had to invest $30 a square foot into that space to attain that rent. And these are the kind of things that have to be considered. Right now, when Stantec downsizes, they're going to have to invest in leasing commissions. They will have to invest in landlord improvements to subdivide the space. So one thing I did mention to the panel, Stantec's space is designed to be one space. It has a central staircase. You saw it hopefully in the pictures that the city has. It's got central staircase through the 3 floors. So it's going to take some work beyond TIs, there's landlord work in order to separate that for lease. So these are the kind of things that over the life of the building, Mr. Pohl, are inevitable. And that's exactly why this is an amortized allowance.
You didn't quite answer my question. You are the owner effectively here today through agency. You see a non-recoverable being put at 3% or 2.6, but put in at 3%. Why would you not have looked at the non-recoverables for the efficiency of the building and use that information here today?
Well, they don't seem to be reporting anything. Again, you don't see structural reserve, for example, on an income statement. And if at the time of and again, coming back to my point, we can't hang our hat on 1 year's financial statement because in a given year, they might not have the other types of non-recovered expenses. But over the life of the building, they certainly will.
Okay, one other question. No, that's okay. I answered myself. All right, that's the only questions I have. Thank you.
Okay, thank you.
Ms. Davidson?
I have no questions. Thank you.
Mr. Danjal?
I don't have either any questions.
So I'm confused about who's filling in the I&E here. Like who's doing the reporting? It sounded from what Mr. Pohl was saying that the I&Es, including the hotel revenue, is that correct?
Mr. Chairman, I'm hesitant to answer completely, but I know that we represent the hotel as well for a different client. It's actually, a different client. And from the financial statement that I see here completed by the owner, they only seem to indicate the tower, and then they actually put 329 Hargrave, which is the parkade beside the parking. So it seems to be those two items combined only and not the hotel. I could be wrong, but that's my interpretation.
Okay. Sorry, Mr. Pohl, were you saying something?
The reason why I was asking is because their net operating income they report, just when you go through the years, but in the last year is 3.65 million. So the parkade can't generate that much on by itself. And if we're already encompassing the office and we're encompassing the restaurants, that's the only portion missing is the hotel. So we're having an assessed value of net operating income for just the office and the restaurants 1.9. So it would have to be inclusive of that. I don't where's that income coming from?
I haven't done the math, Mr. Pohl, but
That
doesn't seem off base really. We have 2/3 of the income attributed to the tower and 1/3 because there's 200,000 in parking income. I haven't done the exact math on the entire property.
I'm just looking at an overall NOI reported at 3,655,000. So.
And again, as I've said before, number one, this is combined with the parking. Number two, we can't look at any given financial statement. This wouldn't have a vacancy allowance applied in that given year, for example. It wouldn't have market non-recovered, market shortfall, et cetera, et cetera. Exactly the caution I mentioned with the Paris building is the same caution I would use here.
Okay. Are three separate titles involved here? One title for the parkade, which I understand is not beneath the building. It's a standalone parkade that is beside it. One title for it, one title for what we're looking at here today as this roll entry, and a separate title for the hotel portion.
I'm quite certain the hotel portion is a separate title. The parkade is part of the whole economic unit from the point of view of the owner. Is it on a separate title? I don't know, but I can find out in one moment, I think. I imagine it is a separate title, actually.
I would think so too. Like there is at least two separate titles, separate ownership. So there has to be a separate title, two separate titles. But I would think prudence there would be for the. I mean, it's a large building complex. So there would have to be for the parkade, I would think as well.
Yeah, the parkade is again 310 Donald, same ownership, and the title. I'll just check what the subject is. Is different. 301-4482 is the parkade. 301-4490 is the tower.
And by tower, you mean exclusive of the hotel?
Correct.
Yes.
Yes.
Okay.
That's correct.
So then, 310 Donald owns what we're dealing with here today, the subject of this application, and the parkade. All of the revenue from the parkade is attributable to the subject property that we are dealing with here.
It's not part of this assessment, but when you look at their financial statements, they've included the parking income.
Okay, because the city has split it out as a separate roll entry, and it has the income approach done exclusively just on the parkade.
Correct.
Okay. And so there's no relationship between the hotel and the parkade. There is no relationship between the owners of the hotel and the parkade.
Well, when you say no relationship, as far as the ownership itself, I don't believe so. As I say, I'm quite certain on that. I could be wrong. There's certainly a relationship, though, because this was designed as a Center Point, I think it was named, kind of as one economic sort of property. And so there has to be related. For example, the hotel has parking reserved in the parkade. So does the condominium tower. So there's a relationship, but I don't think there's common ownership.
Okay. Are the restaurants heavily dependent on traffic going to events at the arena?
I would think so.
Do you know how many nights of the year there's an event at the arena?
No, I'd estimate at least a half or 2/3. I'm not 100% certain.
Okay. You said that they had been suffering during the pandemic. So our reference date is April 2021. At that point, they were suffering due to the pandemic. Is that correct?
That is correct. They filled out the COVID-19 supplemental questionnaire, which is in our evidence, and I think in the cities. They indicate a moderate impact. Most offices we've seen are usually minor. A couple have been significant when they have a lot of retail. And my question I didn't ask today, but I've asked before, what was the point of this questionnaire? Because it doesn't seem to have any relevance to the valuation. The owners are specifically saying, yeah, we're being impacted. Two tenants, the restaurant tenants, are $70,000 and $61,000 in deferral. And in speaking to this is post-reference, so I don't want to say, but let me just say that this is a concern ongoing for the owner. They are not doing well.
Okay, that concludes my questions. Thank you very much. So that concludes, unless somebody wants to summarize, or I've been forgetting about summations. Does anybody want to
No, I
summarize?
just have maybe two follow-up questions, if that's okay, just.
Certainly. Yes.
I park on this parkade every jet game I go to. Like Mr. Slaughter explained, there is separated segments for Stantec, can't park there 24/7. And obviously the other tendencies for the residential hotel components. So there must be some relationship there. And then the only other question I had was as far as generally speaking, I believe this was the third busiest venue as far as NHL cities go. I think I've read that multiple times. But as far as the performance of the restaurants, all of them stayed open, did they not? They were all ordering out. They during COVID, all of them stayed open for this location, right?
Well, what did they say here? Have any of the existing tenants closed permanently as a direct result of COVID-19? Tim Hortons, March 30th, 2020.
Okay, so Tim's probably would have, all right. But the rest of them, I believe, were open. I don't know if you can sit down and eat them during the restrictions, but I believe they were open. You can order.
Well, they probably had some takeout service. Yeah, I mean, it's definitely it severely impacted revenues, but they probably had some takeout service.
All right. Yeah, but
Or not takeout, delivery.
All right, and just so we're clear, Brown Social House, there's lots of them. They're a good restaurant, desirable restaurant. Merchant Kitchen isn't a small mom and pop, like that's a demand restaurant, correct? Like I've tried to get in there, I haven't been able to get in there once.
Yeah, that's it.
Maybe early enough, but it's a high-end restaurant, is it not?
Well, it's a good restaurant. We had our holiday party there. If I guess if Mr. Pohl, if you're getting to the strength of the covenant, I would agree that Tim Hortons is typically a strong covenant. Brown's is a strong covenant. Merchant Kitchen, I would say, is not a strong covenant. Great restaurant, not a strong covenant.
Okay, I get what you're saying there. As far as yeah, no, I get what you're saying there. But as far as desirability, walk up going to, as far as a paying customer, all three are prime tenancies.
Well, again, there's a difference. Do I think they're good restaurants is one question. Do I think they're strong covenants? Do I think restaurants are risky, very risky, especially downtown? Do I think there's a risk that this tenant might not make it and default on their lease before their expiry within a couple of years? Yeah, I do. Do I think Tim Hortons or Browns would? Possibly. It's very common. Downtown Winnipeg is challenging at best.
Right.
Okay, that's it.
Sorry, that's it.
All right. Then can we move along to the next item on our docket?
If we're going through lunch, can I request a 5-minute break?
Certainly. 5 minutes. We'll take 5 minutes.
Thank you.
These days. Oh, they do. Okay. These days, but
We're back.
All right. So we will resume from our recess with the fifth item on our docket, 2181 Portage Avenue. Mr. Pohl, when you are ready.
File number is 221756. Roll number is 0705009200. 2181 Portage Avenue is a civic address. For 2023, the assessed value is $435,000. It's building built in 1953. We have a leasable area of 3,694 square feet. Of which the above area is 1847 and a basement area underneath. If you look on page 3, is the actual subject property. It's on Portage and Moorgate, so kitty corner of that. So if you look at the comparables, again, citywide listing, we have 68 comparables, a little over 100,000 square feet. The average series size is 1,547-ish. Median average or median series size is 1,267, and we have an average of 1,577, weighted average of 1,580, and median at $15. So pretty good sampling of the citywide OFS comparable or citywide OFS comparables. On page 10 is the INE that was submitted. So they have leased out 1,847 square feet. The net lease indicates $13.65 a square foot, as reported to us. Realistically, they didn't put in a basement. We have a substandard basement finished with them, and I'll get to that in a moment. If you look at my workup on page 6. So with $18.47, we have a model of a rent of $14.32, which is pretty close to the subject property. You're off by 60 cents on $14.32 or vice versa. And then we have a substandard basement of lesser quality, obviously, at $2.59. So if you're looking at it from a market perspective, they lease the upper floor. I'm not sure if they have access to the basement, but I would think it would be a throw-in, given the tenancy. But having said that, it's well within market. If we look at the leasable area, again, we have it broken out to the 3694 as indicated. So for the potential rent, we have $31,214. Vacancy at 6%, which produces effective gross income of $29,341. Expenses non-recoverable at 3%, shortfall at $8. Gives us a net operating income of $26,680, capped at 6.25, gives us our 427. Realistically, I think it's pretty much bang on with what we would expect in marketplace. Could it be $1 less? Sure. And contract rent wise, it was about 60 cents less. So with that, I'm open to questions.
Mr. Slaughter, questions?
Thank you, Mr. Chairman. Mr. Pohl, the rent that you cited, that would include the basement, is that correct?
I don't know if they have access to it or not. I haven't been in the building. I would, as I said, I would assume it'd be a throw-in. You would have access to it. They would allow access to it. The ownership may not. If there's a demisable interest, maybe lock the door and see you can't have access to it. But I would think that the tenancy would be inclusive of that. At least if it was my property, that's what I would be doing. But the ownership may be storing something down there. I don't know how that is.
Yeah. Okay. So what we have basically is, you see these on many of the older main thoroughfares. It's kind of a mid-century storefront commercial building, 1 story with a basement accessed only from the interior and minimal parking at the back.
Pretty standard.
You have on page 4 and 5, you have 68 comparisons. Are there any that you think are good comparisons as far as what I just described as a property?
As far as citywide, we just use the average of the offices that we have. If we're looking in isolation for these, I don't think you find enough of them. That would be some sort of reference date where you can get a good subjective market speed. So in this case here, when I'm looking at the totality of the marketplace for OFSs, and they're in at 60 cents or so less contract wise, it doesn't really hurt my interest to explore it further. They're pretty much where you would think the market is.
Okay, thank you. On just quickly, on the very first page, you mentioned the original age and the effective age is 1953. That's what this
Yep.
property is. Yeah. So on page 8, sorry, go ahead.
I'm assuming there's some renovations that occurred in the last 70 some odd years, or that maybe we don't have to account for, but I'm fine with an effective age of 1953.
So on page 8, you have this is the only evidence you have for cap rate, correct? On page 8?
Yeah.
Yeah. And you have the broker studies, and the two of the three brokers actually break it out to A and B. And for the ones that do break out the B category solely, the CBRE and Cushman and Wakefield, their cap rates range from 6.75 to 7.75%. Is that correct?
6.25 to 6.75. Are we looking at for
2.5 would be the age, isn't it?
for suburban B? Yeah, okay, but yeah.
Okay, and the subject is assessed at a cap rate of 6.25%.
Right.
Okay. That is all the questions, Mr. Chairman. Thank you.
Ms. Davidson.
Yeah, just a clarification first. All of your workup comes out to 427,000 for the market value, but on your opening you have 435.
Oh, sorry, my mistake.
It's 427.
No, go with what was on the roll. Sorry, apologize. That was for land value, I believe. Please use the 427.
Yeah, okay. Then I just had a question further on the cap rate. When I look at your table, this is a suburban B, right?
If you want to call it that, sure. It's not an A property. It's not a.
That was a question, sorry.
Yeah, no,
Yeah.
as indicated to Brian. So
Okay, so it goes, you've got the 20th percentile is 5.6 and the 80th percentile 6.9, and is the 6.25 completely model driven?
yes, it is.
Okay,
And just so we can get back to, whether it's 6.5 or whatever, it's a smaller building. When I'm looking at this realistically, you have a lot more tenancies that if you weren't going to be a tenant, you could afford to purchase this and you would look to buy it and occupy it. So there is a relation between what the actual rent would be in place for a tenant versus a purchaser. You simply have more demand and more potential buyers for a property like this. It's a small, pretty much as small as they come. So that's the hence of the lesser of the capitalization rate. So if it would be a larger property, you'd have more obviously income coming into the property for renting, but you would have lesser as CRUs increase, as property sizes increase, if it was like 2 or 3 stories bigger, you would have less of a market that could actually purchase it. So it'd be less competition for it. It's just a supply demand factor.
is this owner occupied?
No, it's not place at page 10, the net rent. It's a law office.
Oh yeah, I did see that, sorry.
And I'm not saying it because it's a law office, it's a better rent. I've seen some pretty bare bones law offices, so I think it's more in line with what you got here.
Okay, thank you very much. That's everything.
Mr. Danjel, questions?
I do not have any question. Thank you.
Mr. Pohl, was this originally built and used for some period of time as a bank building?
The footprint looks as a bank to me. I didn't check far back as far as who was the former owner, and obviously tenant would be the bank. They're almost always owner occupiers as far as properties like these. But yeah, I would assume so.
Then my question is, does it have a vault still in it that inhibits the useful space?
They usually do, and then usually for standalone banks such as these, we would have like how it's classified as a substandard basement. They're really not, I won't say leasable, but they do have value as far as storage. They do have value as far as that element to it. Usually good space is just, there's no windows, there's no plumbing usually down in it. It's just a vault and storage.
So in these types of buildings, the vault is normally in the basement, not on the main floor?
Some are in the basement, some are on the main floor. You do have two.
Okay. Does the football come with the building?
Well, if you want me to give an effective age increase to like 1956, I guess we could work that in.
Yeah, I think so. That's
What I'm
all my
saying
questions.
is like, this is a pretty basic building, right?
Yeah.
That's why you see it.
Okay, I don't have further questions. Mr. Slaughter, give us a second to find your evidence.
Certainly. I do also have rebuttal evidence, Mr. Chairman, that pertains to the next set of properties.
Including this one?
Yeah.
Okay, well, let's hear your evidence and we'll go through questions and then we'll get to your rebuttal.
Okay, sounds good. Just let me know when you're ready.
Well, I'm ready and I'm probably the slowest, so I'll assume that the other two are just fine. So if you could carry on.
Okay, thank you. And I'll skip right to page 6 again. Mr. Pohl has already gone over the property description, but just to confirm, it appears like it was an old bank built in 1953 and is now being occupied by a law firm. It's a small storefront property on the corner of Portage and Moorgate. So the property is leased, arm's length leased. I talked to the owner about this at the reference date anyway, by Carroll Law Professionals. And in my experience, when we see these type of properties that have a basement that's, usually lower grade of finish or unfinished, accessed only from the interior of the main floor. In other words, you can't have a separate tenant occupying only the lower floor. And certainly if there's no fenestration, etc. The basement is usually, the majority of the time in these type of properties, is just part of the rent. So I think it's inappropriate to use the rent on the main floor and then add more rent for the basement. So on page 11, we first identify what the actual rent is, which based on the plan area only equates to $13.64, but if you include the basement, it's something much less. And then on page 12, we look at other rents and we try and stay a little closer to comparability with the subject property. So we've looked at properties all along Portage Avenue, that kind of mid-century sort of building. For the board's reference, I have photographs of each of the comparisons starting on page, quite a few of them, page 18. So at your leisure, you can kind of go through and see the properties I'm referring to. But for the most part, I think they're fairly good comparisons. A few I'd like to point out. The very first is in the 700 block of Portage Avenue. It was built in 1974. It also has a basement that is not part of the leasable area on the rent roll. It's included in the rent. And that lease had $460,000 in improvements put in for the tenant as well. It's otherwise a very good comparison, and its rent is $11 a square foot based on the main floor only, and that includes the basement. And I won't go through all of the other comparisons, Mr. Chairman, but to summarize, I think the best ones are indices 1 that I just mentioned, 5 to 9, and 21. And the rents for these properties range from $10.40 to $12.50. So the point being is, if we look at comparisons based on the plan area only, the rent seems a bit high in the subject property, but there's a reason. It has the basement. If it didn't have the basement, it would probably command about $11 a square foot. So from a completely market perspective, Mr. Chairman, what we did is applied $11 to the main floor. And then where we see these types of basements that don't have access, they command something far less. And we've applied $3 a square foot. We have some comparisons on the bottom of page 13, but these are a little different because they have fenestration, you can access them, and they're sitting at in the $6 to $7. So it'd be much less than that. So on page 14, hypothetically, if we used 11 on the main and 3 on the basement, the total rent you can see on page 14 as a lump sum comes out to $25,858. That's basically what the tenant's paying. All of this to say, Mr. Chairman, we've looked at the actual, we tested it to market. It is at market. We apply it as market. So we're less than the city, of course, because they were at, I think, 13 something plus the basement. We have no contention with the vacancy allowance. The shortfall seems close to actual. We ask for the non-recovered allowance to be applied at 7%. And then lastly is the capitalization rate. I would like to ask, Mr. Chairman, if I could refer the panel back to our capitalization rate study.
Certainly.
Okay. So I'll take a moment and you can refer to that. And I'm going to keep this very short. Once you have that document, if you could please turn to page 15.
Okay,
This is a summary of the broker marketing materials that the city also has in evidence. The last three columns you'll see for Q1 21 are the ones I'd like the panel to look at. Colliers doesn't differentiate between A and B. They just lump it in. So that one I take with a grain of salt. CBRE and Cushman actually break out A's and B's. This is clearly a B. It's not an A. And so for those two brokers, they're saying that, you know, the cap rates would probably be between 6.75 and 7.75. One says 7 to 7.5. The other says 6.75 to 7.75. Two things to point out, Mr. Chairman. One is that if you compare that to what they said in Q1 18, the last reference date, as I mentioned earlier today, we're seeing an increase in basis points for a lot of office. So there's about a 25% or 25 basis point increase from before. That's number one. And number two is 6.25 is too low. You know, notwithstanding the point that the assessor mentioned that smaller properties might have bigger opportunity, less supply, higher demand, lots of capital, etc. Well, these broker studies include small properties too. And we don't see anything in the 6.25% range for Class B suburban. Even if we're at the lowest end of that scale, Mr. Chairman, we'd be at 6.75%. I think 7% might be more appropriate. On page 16, we had looked at 3 sales and done an analysis using the same methodology with the 7% non-recovered expenses, etc. 2 of those were suburban properties, one on Portage Avenue. The first one at 383 Dover Court is based on the actual rent in place tested to market, and it comes out at 7.23% cap rate. And the second one was an owner-occupied sale. It was a medical clinic sold to the Commissionaires of Manitoba. So I had to use a market rent, which is also what we do in this analysis, but using the same sort of methodology. And the cap rate there works out to 6.97%. So our evidence suggests that something around 7% is more appropriate. That seems to be corroborated by the brokers. But what I'm suggesting is if the panel does use the NOI that we're proposing with the higher non-recovered allowance, which again is over the life of the property, we would accept 6.75% as the cap rate. So if I could ask the panel, please, to refer back to the main evidence. On page 16. Is everybody okay with that?
yes,
Okay, thank you. There are 3 main areas of difference between the city's valuation and ours, and I think they're highlighted in blue. We are lower on the market rent based on our analysis of market of comparable properties and the actual rent in place. We have a non-recovered allowance of 7%, and we have a capitalization rate of 6.75%. Our value is $309,000 rounded, and that completes our presentation, Mr. Chairman. Thank you.
Mr. Paul, questions?
Maybe just one really that stands out. I look back and I couldn't find any rent on it. Maybe we just have a misfile in our system, but clearly the signage up front indicates it was a union in there and not a law office. So did you, since you represent the owner, did you canvass who the former tenant and what the former tenant was paying?
Yeah, I try to talk to the owners all the time about this. So he states that the new tenant, because that last lease expired in May 2022, and in June 1st, 2022, IBEW took occupancy of the full building and the parking lot. So that Google photo must be from after June 22.
So the law firm in there is no longer in there.
Correct.
So what is the new tenant paying?
Is that admissible, Mr. Chairman?
Oh, sorry, maybe I misheard. What was the date of the inception of the lease?
The lease expired at the end, I think it's in their rent roll, the end of, or mid 22.
Okay, sorry, if it's supposed to reference, no, I misheard. So that's the only question I had, because obviously the signage is different than a law firm. And I thought it was that's most likely why I didn't find it, because I don't canvass information past the reference date. So that makes sense now. No, I was just thinking in the long terms that it was more of a temporary lease where they didn't even change the signage from the older tenant, and the law firm just kind of was a one-person law firm that occupied the building. So
Yeah,
Okay.
no, it was a market lease that was in place at the reference date, the new lease. So I don't want to talk post-reference, but it's in line with market as well. So,
Do you have any interior photos of the property?
no, I don't.
Right, because I didn't. Okay. All right, that's the only questions I have.
Ms. Davidson, questions?
I have no questions. Thank you.
Mr. Danjal?
I don't have any questions either. Thank you.
You provided some photos of the comparable properties. And obviously, some of the comparable properties are much bigger. Does that have a size factor impact? And is that actually driving down the amount of rent in your comps as an average?
Well, to answer that, Mr. Chairman, if you could look at page 12, because I just want to make sure that it's understood that some of those comparisons are multi-tenant properties. So the rents that I'll be citing in the evidence will be one unit within a building. But to answer your question, where we do have a larger area, like index number 10 in our comparisons is a large unit within one of those larger properties, 1200 Portage Avenue. And it's a larger space. All other things being equal, I 100% agree with the principle of economies of scale. If all of the things are equal, larger spaces will command a lower per square foot value or rent. But most of these comparisons, Mr. Chairman, are in the general size range of the properties we're talking about today in the individual rents. Yeah.
All right. You have vacancy at 6%. So this building has no chronic vacancy issues. You're not.
Correct.
That's correct. Okay. And is this the kind of building, given the small size of it, where the lease is like all or nothing? It's not exactly the kind of building where you're going to split it up into more than one lease.
You mean as far as the basement, for example?
Well,
Or
however it's demised by leases, is it conceivable that it would be more than one occupant or not? I'm just thinking of when it's totally occupied by somebody and becomes vacant. It could be vacant for a while, and there's no
100%.
other income coming in from the property because there's no other tenant.
Right.
What's been the history of this property?
I don't know too far back on the history, but that's a risk at all times, and that's one of the reasons we apply a market vacancy allowance rather than zero vacancy, and why in the cap rates I derive. So remember, I talked about two cap rates of either owner occupied or 100% tenant occupied properties. I still apply a market vacancy allowance in that calculation, and the reason is over the life of the property, you're likely going to experience some times of vacancy. When a single tenant leaves, probably going to have some time before the next tenant comes into occupancy. And that would be a risk in April 21. We know the lease is coming up in a year. That doesn't really matter. I mean, it could come up anytime and you still could face some vacancy. And that would be part of your calculation when you derive or calculate your potential value for the property. So to answer the question, we always apply a market vacancy, even if a property is 100% occupied. But we apply a higher vacancy if there's a chronic case of vacancy in the property, typically with multi-tenanted properties.
Okay. All right, that's all my questions. In which case, that would then conclude 2181. And we can move on to number 6 on our agenda, which is 1868 Portage Avenue.
So, Mr. Chairman, I have the rebuttal, but to be honest,
I'm sorry, I forgot about your rebuttal.
No, it's fine. I can bring it up in this next case because in the one that we just went through, it's an actual rent. I don't know if we need to talk that much. So if you'd like, I can save the rebuttal for the next presentation.
And I will attempt to remember that time, but there's no assurance of that happening.
Yeah, no problem.
Mr.
Pohl, when you are ready.
File number 22-1230. Roll number is 0702015800. Civic address is 1868 Portage. 2023 assessment is for $431,000. We have a leasable area total of 2,271 square feet. And we have a plan area of approximately 1,593 square feet. So we do have basement area in there. So if we turn on page 2, highlighted in, I guess, purple, it's 1865, it's mid-block between Ferry and College Gate. If you look at page 3, it is a chiropractic center. The signage is for the property on the other side. If you look at the signage on the wall of the white, that is for the subject property. Just that's the way the photo went. So if we look at page 5, I have 2 groups of comparables to use. Simply what it would be rented out as an OFS. We've already seen them. And that's the 1577, 1580, and $15 for the average, weighted average and median for the comparable group that we just saw. So we don't need to talk about them. We already went through them. But I also looked out as what it would rent out as an OFM, as it is a chiropractic center. Typically, your finished units are greater. The offices are greater finished areas. You get a bit greater than average rent. Considering. So I looked at, as you can see, 34 comparables, ranging from $21.81, $21.50, and $21.75 for the OFM portion for average, weighted, and median. And those CRU sizes are median is just a little over 1,500 square feet. So when you look at then the INE, just so we're clear, they are starting on page 15. They are owner occupied. There is no rent, or a book rent anyways. There's no arm's length rent. So that's what they declared. So having said that, the book rent is $24,000. So when we get to the actual workup is on page 8. Again, the median size CRU for the OFMs was about 1,500 square feet. This is just under 1,600. We have $16.39 applied to the upper area. For the substandard basement, we have again 678 square feet at around $4.05 rent. So that produces a total PGI of 28,855. So same standard parameters that we've already discussed at 6% for vacancy. Expenses non-recoverable at 3% and shortfall at $8 gives a net operating income of $25,220, capped at 5.85%, gives us our 431. So again, same idea, smaller building, more players can be involved in actually purchasing a property like this versus say 1,200 Portage. Not too many small proprietors who own a chiropractic business will be able to buy property like that. So the cap rate is going to be on the smaller end of it because simply there's more demand. So I don't think that's out of line with the cap rate just under 6% given the subject property. With that, I'm open to questions.
Mr. Slaughter.
Just one question. So this property, again on Portage Avenue, storefront, mid-century construction. Now the cap rate instead of 6.25 is 5.85%. And sorry, the reason why it's going that low is?
Yeah, well, realistically, supply and demand. You have more players involved. Like I said, if you're running a small business, you could purchase this property, and then ultimately, if you wanted to rent it out as owner afterwards, you could do that as well. Versus like you indicated, the strip mall there, you would typically be able to do on Portage or 1,200 Portage, same idea, or the mid-block. I think it's 3-story. Is on Portage as well. Those are, you need a lot more depth of pocket to purchase that, so you'd have a lot less players involved. You have less competition, so reflecting a lower selling price. So.
Yeah, even if I agree with that, Mr. Paul, which I don't, the fact is you mentioned that on the last property at 6.25, and this is 40 basis points less.
Yeah,
So,
well, again, we have a 1970 effective age, and we also have the building being converted over to a chiropractic center, which has a greater finish. It would be a bare basic building anymore. And, all things being equal, there would have to be a renovation to accommodate the use of nature. But I do have some questions, but I think that's more appropriate to ask you once you're set the presentation.
So just make sure I understand, you think a chiropractic office has a greater degree of finish than say a law office?
I don't think the former building had a high degree of finish. I think it was just a bare bones. Wall is there.
That's all the questions. Thank you.
Ms. Davidson?
I have a question. You provided comps for both, office and office medical, but you did it on the OFS instead of the
Yeah, it
OFM.
came, model was OFS.
Is that because that's, oh, sorry, go ahead.
Okay, model was OFS, but when I looked at the property, it's actually a chiropractic center.
Right.
So in order to be a chiropractic center, you're not gonna have a typical office layout. You need to have individual rooms.
Right.
Operatory, I don't think it's actually called an operatory, but massage rooms, you need different ones. So there need to be a level of renovation done to this. And usually it's a better waiting area, office, more desirable. It's not a spa, but people go there as to get their back worked on, to get their chiropractic massage. You would expect a greater degree of finish in this than an average, like the property that just saw.
So then, does that mean it's done, even though it's called OFS, it's actually done as an OFM?
Well, I looked at
Or
it,
just adjusted as an OFM?
I looked at it, what would the rent be in place if the owner was not renting his building out? It would most likely be in the OFM bracket.
Okay,
But I also looked at it, okay, realistically, if they scrape that and put it back to an average office, what would most likely rent out at? So I did both both comparisons. So with what we have on file from the model, right page here. We have a rent of $16, realistically 39 cents. I think that's pretty reasonable, given that for an OFS you're at around $15. And if you improve the building a little bit to accommodate this kind of rent, you're probably looking not probably 20, but pushing that. So
okay, so then is everything model with the exception of the rent which you adjusted?
no, I didn't adjust anything. No, I didn't adjust anything. This is all model.
Okay.
I'm simply doing the
It's just your analysis.
just my analysis. I didn't see anything here that warranted an increase or change. So realistically, if I bought this building, anyone could scrape what's in there and put a storefront in, retail, anyone could put a small office in, or just continue it on with massage or dental office could go there too, is depending on configuration. So
And it's 1958, was an effective year of 1970?
and I would assume that would be based on the renovation that took place.
That's gonna ask
Get
you
into that. That's why I was indicating the other office that we looked at, most
Yeah.
likely it's just bare bones. But this one here obviously had something done to accommodate, see to get the occupancy permit for it, so.
So that's why the cap rate is sort of in the middle of your
Yeah.
models.
The model would pick up on the level of renovation, the effective age would be increased.
Have you inspected the building or been in it?
No, I haven't.
Okay, thank you. That's all my questions.
Mr. Dunjal?
Just to clarify once again, the overall capitalization rate at 5.85. Is there because it's a potential high purchasing building? Is that?
Yeah, you have more, like from my perspective, you would have a greater potential purchasers for it, right? But also there is a level of, I won't say large, but a smaller degree of renovation that did occur to the building to convert it over to its current use. That's why the effective age is a little different. Versus the other building where we don't have any information to be able to increase the effective age on it. So the model would have picked up on that as well. So that's why there'd be a slight difference in capitalization, right? But realistically, both of these properties are small capital investments. They're not large capital investments. So you have a greater degree of people who would be willing to purchase it, whether it be owner occupier for a period of time and rent it out or vice versa. You could simply rent it out as well. So more demand, you typically get a higher price, and given the market being the same, your NOI is obviously you're going to make them divided by your sale price, so you have a higher sale price. Again,
That's the only question I have. Thank you.
So what is your blended rate then for the rent?
I didn't do a blended rate. I didn't think it was appropriate, given that it's a basement with a substandard finish.
Okay.
So I think realistically, you should be looking at it just what the main floor was rent for.
All right.
I mean, I haven't been in the basement. there's no demising, I don't think there's a demising entrance to it. It's probably just a toss in as far as what they use. But that's typically how you see these buildings being operated on.
Okay. And this is owner occupied and there is no sales history. How far back do you look for sales history?
For me to put any weight on it, I mean, appraisal theory says 3 years. I realistically look at how the length of time that occurred between the sale and what the commercial properties have done. If you have how do you phrase the right way? I'm always doing an independent analysis from a sale. It's not tied to that sale, but if I say I have a value at X amount that's sold 8 years ahead of the reference date, and we know it's a rising, escalating marketplace, and we have a assessed value that's a little bit above it or in line with what you would expect, and maybe put a bit of weight. But if I look at it and I see a property that was extremely different one way or the other, I might investigate the sale, but realistically, I would just put the weight on what it is at the reference date, because it's too far away from the sale to put any from the reference date to put any weight to it. So
You don't know how far back the owner bought this property.
no, and I wouldn't be investigating this. These sales typically come up as generated within our within our camera system. They would be flagged, so it would come automatically. So unless I know of the sale, I'd independently investigate it. But for a property like this, it usually I wouldn't be investigating. I investigate the investment properties like your Class B's and A's, independent of an assessment. So,
okay. Just out of curiosity, and not really relative to the value of this property, but sometimes what you describe as a mom and pop building is done on sales as opposed to on the income. Is it a general rule of thumb that you use as to which way you go?
for these particular hearings, I would be looking at the income approach. If I'm sitting at a municipal board, I'd be exploring all approaches. Obviously, cost would not be a factor. I'd probably put a commentary in, but I wouldn't investigate that. But I would look at it as per square foot is what it would be bought for. A lot of these properties are bought never with the intention of renting them. They're bought with the owner occupied eyes kind of thing, and sold in that way too. So that is one aspect for the direct sale comparison, but I didn't explore that for this appeal. I think the most equitable way at this point in time would be income.
All right. Thank you. That's all my questions. So then, Mr. Slaughter, your evidence.
One last question, Mr. Chairman. Mr. Pohl, you mentioned that you mentioned renovations. I guess my question is, when did these renovations occur?
That would be in line with my questioning to you. Obviously, hold on. Obviously, we see that a building was as such, and it is now a chiropractic center. You'd have to have an occupancy permit for that. And you would need separate rooms for individual clientele patients to be treated in. So there must have been a renovation which occurred for the owner of the property, unless they bought it as such, which would be more in line of questioning to me.
Okay, yeah, that's all my question. I can talk about more after, but thank you.
Okay, if you could proceed with your evidence then, Mr.
Thank
Slaughter.
you. Rebuttal first, Mr. Chairman, or direct evidence?
Oh, go to... No, direct evidence, but don't let me forget.
Okay, thank you.
Let me forget rebuttal.
Okay, thanks. So again, if I could just ask the panel, please, to turn to page 6 and 7. We've got some photographs that Mr. Pohl has already gone through that. The only things I'll mention about the property is that I don't have any record of recent renovations. We buy permits from the city of Winnipeg since about 2014 and watch those as well. And I have nothing on record for this property. So if the renovations occurred, I think it was some time ago. And the second thing I'll say about this property, because it otherwise is very similar to the other properties we'll talk about today. It's one of these mid-century storefront Portage Avenue properties with minimal parking in back, main floor only, basement accessed only through the main floor, not commanding any additional rental potential. This is not an OFM. A chiropractic office is essentially like any other office, except your guests lie down instead of sit down. This is not extra plumbing like in a dental office or in a medical office. And the main difference is, if you look at and I'll talk about this in rebuttal, but the OFM comparisons are typically found, at least the ones listed by the city, in retail sort of locations or office buildings that are designed for medical offices. They have ample parking. They're not at all comparable. So I would suggest that we stay with the classification of OFS. And so, Mr. Chairman, I treat this the same as the other properties we're looking at today on this part of the hearing. And I have the same comparisons on page 12, which are all on Portage Avenue between the 700 block and the 3000 block. And there are various types of properties. Some are multi-tenanted, some are single tenanted. I would suggest that the two best comparisons, again, are number one, which is the one I mentioned before that includes the basement, no extra charge. So, they don't have a separate rent for the basement. And that rent is $11 a square foot based on the plan area only. And number 21, and there's a photo of that one too. It's another storefront main floor property, 1,200 square feet, and they pay $10.40 a square foot. So the subject property seems to me to be in a slightly better condition than the last property or those two comparisons. I would use a slightly higher market rent, but I wouldn't go much higher than what the evidence is suggesting. And I apply $13 a square foot. And I would be more comfortable not applying any additional value to the basement for the reasons I mentioned. But to stay consistent with what I did on the last property, we'll use a rent of $4 a square foot, a little bit higher than the last property. So on page 14, we have $13 on the main and $4 on the basement. And that's really one of the main contentions between us and the city. The other two, again, we feel that the non-recovered allowance is appropriate. And lastly, the cap rate. I don't agree with the logic the city's using. I mean, even if there was evidence that there was higher or lower cap rates for smaller properties, we would see that in the evidence from the brokers. We'd see that from the evidence that Altus provided in the cap rate study. The fact is, if I wanted to get into the investment market, I'm not able to buy the properties that are larger myself. But I have the avenues of either a syndicate or a REIT, and that's how the market operates. So I don't see the evidence supporting that claim that we're going to have lower cap rates on smaller properties, especially when they're older, small land to building ratios, et cetera, et cetera. The evidence suggests that the range is between 6.75% and 7.75%, and we have again used 6.75% on the low end, partly because we asked the board to recognize some of that risk in the elevated market, non-recoverable expense allowance. And so on page 16, we apply our market rent with the market vacancy, market shortfall, 7% non-recovered allowance, and a 6.75 cap rate, and our value is $287,000. And that concludes our presentation. Thank you.
Questions, Mr. Polo?
Yeah, just generally speaking, you're representing the owner. Did you ask the owner when you're investigating if they converted the building to a chiropractic center or they purchased a chiropractic center?
No, I didn't have a chance, but what I did do is look for any recent sales or renovations, and I don't see any, at least.
I didn't either, so that's why I was asking. Typically, you would think that there'd been a renovation done by the business owner who purchased the property. But you don't know that question. Okay, so have you been in the property?
No, I haven't.
Do you know how many rooms as far as massage rooms there are?
No idea, but I can say, Mr. Pohl, that in my opinion, a chiropractic office isn't like what people call a medical office. Again, it's basically a reception, and then you have individual offices.
Not the question I asked. I'm not saying the rent should be in place as, say, an operatory. That's why I didn't call it an operatory as far as I'd say dental office or such. There would be commanding a different rent because there'd be a different fit up for that, and the owner would have to charge accordingly. So I'm not saying that. But what I'm asking is how many rooms there are, and then of course these businesses are usually operated as one practitioner, but there may be other practitioners working under their banner, meaning they rent rooms out to them. So do you know how the business is set up here? Is there multiple practitioners here? They're working underneath one guy where there's 3 other people working, running different rooms, and then they're being charged rent for those rooms?
I don't know.
Typically what happens.
Yeah, I can't answer that, Mr. Paul, I'm afraid, but I do know that there's no additional rent reported, for example. So my suspicion is that whatever relationship they have would be a business relationship, not a real estate relationship.
My main point to that is usually if you have 6 rooms running, there's only 2 hands for the practitioner. But that's
Yeah.
why this kind of thing runs into where you have associates working and they rent rooms out underneath your banner, and maybe you run 3 of the 6, I don't know, but
Yeah.
that's-
My suspicion is based on the area that there probably is multiple rooms, but I would imagine, having been in many or some chiropractic offices, it's probably not going to be materially different than any other offices we discussed today.
Okay, I do agree with you. I presented 2 sets of comps and I think I bracketed them all where I think this should be modeled and sold as an OFS. That's why I didn't change, but given the usage, if it were to rent in the current state that it is, it would most likely have to be rented to a practitioner of similar nature. You couldn't, given what must be in place, rooms, massage rooms, you couldn't rent it out to, say, an office.
You're correct. I don't know how that affects the value, though. I don't think it enhances value.
But that's how the rent would be. You would have to have another renovation to take it back to an office tenancy.
I'm not sure about that, Mr. Pohl. In my experience,
Oh.
there isn't really material difference between a chiropractic office and an office.
You have individual separate massage rooms. They're usually 8 by 6 or 8 by 10, roughly. You'd have several, because you're not just in one massage. You have
Just like in an office, you'd have several offices about the same size. Yeah.
Getting to your cap rate. You're well suited to accept economies of scale as far as rental and CRU sizes, differentiating between the rental rates. How come when it comes to actual sales, you don't apply the same perspective?
Well, economies of scale is something that we recognize in a rent or a sale price. A cap rate don't, because the cap rate is a relationship between the sale and the rent. So I don't think that you would additionally add an economies of scale adjustment to the cap rate. I mean, it would already be born in.
Well, you just said it'd be for the sale price, and of course, the sale is not one of the 2 components to a cap. So if you're applying it to a sale, then you'd have to take that into account for.
Yeah, again, though, it's kind of a hypothetical question, Mr. Pohl, because an economies of scale is an adjustment from something to something else. What are we don't have sales in evidence to base that on. We're doing an income approach to value. I would recognize economies of scale in the appropriate market rent, certainly. Again, if all other things are equal, but I don't adjust capitalization rates lower because a property is smaller. I think I don't believe that's an appropriate adjustment.
Getting back to the reporting, different bodies that report different cap rates, would it not be reasonable to you to assume that typically when they're reporting cap rates, they're not doing studies on 15, 14, 1600 square foot CRUs, buildings that are standalone 1950s era? It just isn't any of that information in those cap rate studies that includes this type of subject property. It's so low in the investment potential that they're just not looked at.
Possibly, I don't know. If the broker has gone through the trouble of differentiating between A and B suburban office, I don't think they'd exclude the sort of properties we're talking about today. And again, their range is 6.75 to 7.75. So I see no evidence to make a further adjustment, especially a significant adjustment to 5.85% from those ranges.
That's all the questions I had.
Ms. Davidson?
I had a question on the comps that you used. I think I heard you say that number 1 and 21 were probably the best.
Yes.
What use are they? Are they also used as chiropractor offices, or are they used as a more traditional office?
I might not be able to answer for all, but number 1 is Child and Family Services.
Oh, okay.
And number 21 on photograph, I might be able to tell. I'm not sure. It's called Prairie Sky, so it's some kind of office. Doesn't sound like a chiropractor, though.
I don't know. Okay, thank you. So that was all I had.
Okay.
Thank
Mr.
you.
Denzel?
I have no questions. Thank you.
And I have no questions. So that concludes 1868 Portage Avenue.
Sorry, Mr. Chairman.
Except for the rebuttal.
I'll be quick.
Okay.
Okay.
So where is
yes.
it? Sorry, where is it on the, because I didn't
Very
receive.
bottom.
Oh, sorry. I'll wait for everybody to get it.
Okay, all right, I got it now.
All right. Go ahead.
Thank you. Again, I didn't focus on the OFM. I just think that's not comparable, but the OFS, the city has included a lot of rents. I think 68 it was. And I spent quite a bit of time going through those, not to nitpick, but just to make sure that, what we're talking about is fairly similar. And again, it's hard to find exact comparisons, but you try and get a little closer based on the characteristics. So I thought it was important to just highlight some of the comparisons. When we get over $18 a square foot, basically, for suburban office, Mr. Chairman, there's a reason for it. And it wouldn't be appropriate for the subject property. And I think this is important to point out because, of course, those rents are skewing the average higher. So just very quickly, and I won't go through every one, the crux of it is if it's over $18, there's a reason. It's either newer or it has ample parking or there's something about it. And I've tried to highlight those in every case. 4 of the comparisons used are from 301 Nassau, and that's a fairly good comparison, but the rents in this property clearly communicated to the city by the owner in the income expense mailers are semi-gross or gross. And we represent this owner. So I've included on page 3 the owner's calculations of the rents and our calculations of the rents. And they're very different than what the city is showing. And then the others, I won't go through each one, but you can see they're very, very different. They're either new or they're ample parking or they're retail strip locations. So I just wanted to point that out because it does skew those averages. And again, it comes back to my question of the assessor. Well, which of these 68 would you consider good comparisons? And frankly, I think our evidence on market rents is a little bit closer to the type of properties that we're talking about today. So that's all. I'll answer any questions on that. Thank you.
Mr. Paul?
Don't have any questions, sorry.
Ms. Davidson?
I have none either, thank you.
Oh, sorry, maybe I got one. If you're doing it just on these, why wouldn't you done it on all of the comps? Are you agreeing with the other ones that you don't see other
No.
than?
To be honest, Mr. Paul, I ran out of time. That's the honest answer. So what I tried to do.
It just seems like you're being selective in which ones you're bringing forth rather than all of them. That's all.
Yeah. In the end, what I had to do is say, look, I know that anything over, well, frankly, $15 is inappropriate. I have to communicate why. And so I focused on the ones that I think are just not comparable. And that's all. I was going to try and do all 68, but that's a pretty big task.
Okay. Ms. Davidson?
I have none. No questions. Thank you.
Mr. Dunjall?
I have no question. Thank you.
And I have no questions. So now we can move along. 1793 Portage Avenue. Give us a second to bring that up. When you're ready, Mr. Paul.
File number 221186. Roll number is 0702177800. Civic address is 1793 Portage. The 2023 assessed value is $467,000. We have a building that was built in 1950. We have an effective age of 2000. There was a small renovation that occurred to it, as you can see on the picture. It's from page 3. I don't have any interior photos of the property. Haven't been in it. We have a plan area of 1,680 square feet and a basement area of such for a total usable area of 3,360. So it is on the corner of, not on the corner, it's mid-block. Between Hampton and Barrie on frontage on Portage. So same comparables that we were discussing earlier, so we don't need to discuss them again. There appears to be a mortgage company in place, and again. So we go back to the IME, same scenario where they are occupied. Starting on page. Right. On page 14, the rent roll indicates written in owner occupied and owner occupied on the annual income and expense side of it on page 15. So we have a total leasable area of 1725. I'm assuming that's the main floor. So they don't have to go to the basement. So having said that, our comparables are the same. So I'll go straight to page 7. The workup is for 1,680 square feet for both basement and main floor. We have $14.39 for the main floor and $3.60 for the substandard basement finish, which produces a PGI of $30,223. Our vacancy at 6%, our expenses non-recoverable at 3%, and our shortfall at $8 produces a net operating income of $25,945, and that's capped at 5.55%, which gives us $467,000. So with that, I am open to questions.
Mr. Slaughter, questions?
Thank you, Mr. Chairman. Mr. Pohl, up until this cycle, this property had an effective age of 1950, the original age built. Is that correct?
Yeah.
I think you know where I'm going with this.
I don't have any permit information indicating why. I see that there is a storefront. You can see from page 3. They obviously put a little bit of work into it, but I don't see much. So I was hoping that you'd be able to share any permit or any interior photos of the property, but I didn't see any in these grandfathers.
Yeah, I'd love to if there was any, but there hasn't been. In fact, I talked to Buzz Grant, the owner. I was in the property when we first started working for him a number of years ago, and I said, Mr. Grant, the variant age on your property has changed. What improvements have been done? He says nothing. Nothing's been done. Would you agree with me that that's probably an error?
I can't say at this point. I mean, I would think that if there is something, then it wouldn't warrant that significant of an effective age increase. But mainly, maybe I'll throw it back at you a little bit here. You're talking to the property owners, you see an error here that you suspect. They can't take a few snapshots on their phone and send it to you. You don't even need to be with the property. Like, we don't have any interior photos to go from.
Well, yeah, I mean, I guess we could have, but I can state under oath that I've been in the property. There's nothing about this property which is superior to any other property we're talking about today. It's a standard mid-century. Every property goes through a little bit of TLC over its life, of course, but
and that's kind of where I was going with it, where I indicated like there seems to be a little bit, but I don't see. I mean, I'm at a bit of a loss as far as any visual inspection.
Yeah, I'll just state, Mr. Pohl, that effective age is wrong. I'll state that. Okay. But the point is that effective age will influence the model's application of a market rent and capitalization rate. Is that correct?
And that's why I'm getting to the cap is at 5.55. That's given up on. But as far as I'm concerned, if there was an issue and you saw that, you could have contacted me. We could have went for an inspection. We could have got even the property and sent pictures. We could have clarified that before they were very easy.
Yep, point taken. In the future, I will endeavor to do that. Thank you. That's all the questions, Mr. Chairman.
Ms. Davidson?
I have no questions. Thank you.
Mr. Danjal?
I don't either. Thank you.
Just one. Looking at the aerial photo and considering the previous ones, the previous applications that we've looked at today, a lot of small properties all along Portage Avenue, up and down that stretch, and it's quite a long stretch. What is the tendency when these things do come up for sale? Do they stay vacant for a while, or do they tend to get snapped up in the market?
No, they tend to get bought pretty regularly, like, and that's why I was getting, some of these never have eyes of either purchaser or seller to ever be anything other than owner occupier. Because if you're gonna be paying a rent for 10, 5, 10, 3, whatever it turns out to be, and you're gonna have to continually be renting, as a renter, I'm going to be renting forever. So whether it's a 3-year term here or a 5-year term at the next place I go, rather than investing that money into someone else's pocket, I'll buy a small property. And yeah, it's not a large property, investment property, but it's good for our purposes for running our business out of. Some of them are just occupied that way. And then at the end of the day, if you retire, you may sell it, or if you retire, you may run it as an income potential property there as far as a renter. But some of these are just bought on a square foot basis based on what the building is and never have any attention to being an investor like that. That's just the nature of the marketplace. Once you get down to buildings of these sizes, and that's why I was indicating, when you look at them, you have a much more demand for a building of such nature versus if that same tenant was going to be looking at a large, even if you triple the size, and it's still a fairly small building. If you triple the size to say 4,500 square feet leasable area, that's 3 times as much money you have to pay. Most people, that separates your market out. So for what someone can afford to pay as far as operating a business out of it and ownership of the building as well. So that's the nature of these.
All right, thank you very much. That then concludes 1793 Portage and brings us down to 1151 Portage.
Oh, Mr. Chairman, I think, wait a minute.
Maybe, am I?
I think I still have to present.
You still have to. You can tell that I have not had my lunch yet. I'm getting punchy. Spending more time thinking about the stomach growling. Go ahead.
Okay, thanks. Well, we're almost done, and I'm going to
rebuttals and on presentations. My apologies.
No problem. And I'm going to try and keep it as short as possible. But the property is we're talking about really very similar properties amongst the 4 that we're going to discuss now. The 2 previous and the next one as well. So the evidence stands the same, Mr. Chairman. To the comment about these properties sell quick and people pay good money, my only comment to that was, well, certainly we see vacancies in these properties, and we see holding periods before they, or not holding periods, but vacant periods before they sell. And if the city has evidence of these sale prices, I think they should probably put them into evidence. But we are doing it on an income approach to value, the same evidence that I've presented on the other properties. So maybe if I could just ask the panel, please, to turn to page 13. As mentioned, I have been in this property before. It's very basic, limited parking, et cetera, et cetera. I confirmed with Mr. Grant that he has done nothing in the last number of years to improve it. So I would put this kind of in the mid-grade between the first property we had and then the second. If you remember, I had $11 on the first one on the plan area only, and 13 on the second. I have this at $12.50. And then again, I don't think we should be adding a rent to the basement because the market doesn't do that typically. Our comparisons that have basements, it's included in the main rent, but we have again applied a mid-ground rent, this time $3.50. So I think it's well supported by the evidence. That's the one contention. The second is the non-recovered expenses, and the third is the capitalization rate. I didn't think 6.25% was appropriate. I certainly don't think 5.55% is appropriate. Again, this would be within the range that the brokers say. I don't think there's any evidence to suggest otherwise. Our comparisons of suburban office seem to hover around 7%. One of them is on Portage Avenue and did sit vacant for some time before commissionaires bought it. And so on page 15, then we have the reduced market rent, increased non-recovered allowance, and a 6.75 cap rate. And our value, Mr. Chairman, is $331,000. And that is all. Thank you.
Mr. Poole?
Just one question. Obviously, in lieu of pictures, you talked to the property owner. Did he take out any permits whatsoever? Did he do anything that would trigger?
Well, As I mentioned, we've been buying permits since about 2013 or 14 from the city. So we get them every month and we go through those and we track them on property to property. I see nothing on this property from that time. Has he taken out permits in the past? I'm sure. Has he done anything in the last 5 years? No.
So you asked him and he said, no, okay, I'll have to look at this further. Okay, thank you.
Yeah. I can take his direct quote here if you'd like, because he just got back to me yesterday.
Just, it's a big jump from 50 to 2,000.
Yeah, as I say, I think it's an error, but hi, Rod. There have been no improvements over the past 5 years at all. The basement is unfinished only, has some archive record storage. There's no windows in the basement. I was just confirming about the basement as well. I trust this helps Buzz Grant.
All right, fair enough.
Any other questions?
Nope.
Ms. Davidson,
I have no questions. Thank you.
Mr. Donjal,
And I don't have either. Thank you very much.
and I have no questions. Okay, thank you very much. Excuse me. So now we will move along to 1151 Portage Avenue.
File number is 221242. Roll number is 130960718000. 1151 Portage is the address. The 2023 assessed value is $1,286,000. There is a non-co-op request for section 53(3)B Municipal Assessment Act, and if there is a reduction order, that it followed 54(3.2) of the act as well. If you would like me to get into it, I can, or if you want to respond from there.
Could you give us the evidence that there was not cooperation?
On page 11 is the certified mail that was sent. On the second request, signed at the bottom. On page 12 and 13 is the cover letter that went along with it. On page 14 is the blank mailer. Obviously, we didn't get it back that we sent to the property owner, and there was no response. And there was no response to the COVID questionnaire either. So with that, they're not compliant. There's 2 attempts made, and obviously the certified mail is what we're using, but it wasn't responded to.
Okay. Mr. Slaughter, do you contest the city's assertion that there was a failure to cooperate?
I do. Thank you, Mr. Chairman.
And your evidence is?
If I could ask you to go back to the rebuttal evidence I provided for all properties, there is something in that evidence pertaining to this property.
Yeah, just a minute.
Very last page.
Yep. So I'd asked the owner about this, Mr. Chairman, because I know this client has been compliant every single other year and since 2021. So I said, what happened in this year? You're always compliant. He said, well, we did. We submitted it. We submit by fax. I said, well, the city doesn't seem to have received that. Do you have any evidence of that? So he sent me what I have in evidence here. And it's the May 6, 2021 questionnaire. Unfortunately, he doesn't date it properly, but
sorry, can you tell me where?
Oh, it's right at the end, Mr. Chairman. If you go past all the pictures,
okay, yep.
past page, it starts on
Due
page
date, May
9,
6.
10. Yeah.
Uh-huh.
Yeah, so it's
Okay.
the dated May 6, 2021 mailer, which would be the 2020 year. He appears to have filled it out. He had this obviously in some sort of record storage because I can see the hole punches. And so he sent that to me. So I am left having to state that as far as I am concerned, under oath from what the owner is telling me, he did comply by fax.
Back to Mr. Pohl. Mr. Pohl, do these usually come in by fax?
No, I'm not saying we can accept it by fax, but I mean, before we get to that portion, we sent this dated, the certified mail dated August 24th, and it wasn't responded to. Correct? We at least have confirmation from the agent that the one sent in August, signed, made its way to the property owner. That is their signature. That is the person held up from us to us to respond, and they didn't respond to this. Because if you've already sent it in prior and you're receiving this, you would look at it and go, hey, I already responded to that. And you would respond to this. But they didn't respond to the certified mail. That was.
Well, he may have thought, Paul, that, I've already provided this must be an error and didn't think twice. I mean, is it possible he faxed it in and it for some reason wasn't received? Or missed?
That's not quite the question I'm asking. I'm just asking, did you ask if they responded to this one?
No, I just asked, did you comply? And he said, well, yeah, I try and comply every year. I said, well,
So they failed to respond to this individual request. That's a definite. Now getting to the fax portion, mailed out and what's scribbled underneath there? I'm not
sorry, which page?
on like we're working backwards. Sorry, I guess it's 1, 2, 3, 4th page. So the top of the annual income and received and annual expenses and property information received.
Yeah, I'm not sure what you're doing there. At first, it looked like this was the wrong year, but then I looked at the due date on it's May 6, 2021, and I compared this to the 2019 mailer, and it is different. So it definitely is pertaining to 2020. I think he crossed out the date thinking, oh, wait a minute, this is a 2020 mailer. I don't know.
And we don't see any actual dates as far as the signature on the bottom.
Unfortunately not, no.
Independent of this IE that claimed to be faxed in, they did fail to respond to the secondary mailer that we sent, correct?
I would expect they would if they thought they complied already.
Okay, so, all right, thank you.
Ms. Davidson, questions about this?
Just to straighten out the timeline in my mind. So the fax is dated June 22nd, 2020.
That would be the initial, we sent out an initial mailer
Right.
and we want response to that. Sometimes property owners send back and get a request for extension. We give an extension if it's appropriate to determine that. If we don't receive a response, we follow up with a secondary mailer by certified mail, which is the one you see that was not responded to. So there was a request made and there was a failure to respond.
But the first, is this a response? Okay, you didn't get it or whatever, but the June 22nd, 2020, is that a response to the information you were asking for?
Yeah, well,
And
we obviously sent out the second response because we felt we didn't get this. Now, I can't fact check whether we got a fax right now. But what I'm saying is we did send out a secondary mailer, which they did not comply with.
So I'm just asking, so like this looks like they sent a fax in, at least the date on the fax cover.
Yeah.
To your original mailer. The city somehow didn't get to the right desk or whatever. And then you sent out a second mailer.
Yeah, assuming,
Yeah, I'm just trying to get.
For first initial mailer, we see a fax date of June 22nd.
Right.
Stamped on that.
Yeah.
But then we see a crossed out date.
Right.
Which says June 30th. And I don't know what after that. So if it's June 30th and they sent it on June 22nd, I don't know how they could date it June 30th and send it June 22nd. And then if you look at the signatures on the bottom of the other two pages, there's no dates. And it's also done in pencil rather than in pen because you haven't written in pen on the date on the top of the page. So I have some questions regarding the first response, whether we got it or not, but it seems to be some issues with not signing it and dating it, and we need to date it and authorize date it. It's part of the act. It's part of what we're supposed to do. And the fact that it has a different pen. I mean, if you're filling out that form, I don't know why you're using a blue pen at the top and crossing out a date or crossing out something. And then not filling up the date for the initial response. But regardless,
what people do.
and then when you get to the second you still failed to respond to the
Sure.
our second email. So in my eyes, it's still a failure.
Okay.
And
No, I'm
that's
just
the
trying to get the timeline, just a question. And my other question is given this attachment of this fax in terms of asking for your non-compliance, was there effort made by someone at the city to locate this fax to see if it ever came in? Like, are they logged in the city or
No,
do they just come in on a?
I typically, if someone locks them in, they give it their clerical, we stamp them. I'm assuming our the person doing the faxes would also be stamping and giving it to the public. I don't think there's a way that I could actually track
So
that.
they're not logged or whatever. So there wasn't really.
Honestly, I can comment. I don't know how there would be a process to go back and track to see who received this on.
Okay, so that wasn't
No,
included.
but I mean, if they faxed it on June 22nd, I don't know why it's June 30th. Time doesn't.
Okay, all right, that answers my questions. Thank you.
Mr. Danjal?
So there seemed to be a discrepancy as far as the date is concerned and no evidence from the city side as far as receiving this particular assessment. Am I correct in that?
If you're asking me, I
Yeah.
see a cover letter that says it was sent on June 22nd, 2000.
Okay.
Then if I follow down, I see crossed out in blue pen, June 30th, which is 8 days after. And then I see a form filled out in pencil. And then when I see, as you go down, the signed signature, Ken Lee, and then you see a date, it's left blank. And then if you give the secondary opportunity to do the same, which is on the last page, it's the same thing. So that seems to be odd that we would receive it signed blue pen 8 days apparently ahead of time. I can't comment on that any further than that. So as far as I'm concerned, though, we sent another mailer, a secondary mailer, a certified mailer they failed to respond to, and they signed for it. They clearly got it, and they returned it blank. If I'm the original, if I sent that in, I'd be responding to it saying, hey, already previously filed, refiling it, or please call me or something. In the end of the day, they failed to respond to a request for information that we sent, which is their secondary mailer.
Right. That's the only question I have. Thank you.
So you would have sent the mailer out in April of 2021, and it has a due date of May 6th, 2021. Is that correct?
Yes.
Okay, and so the 12 months ending, according to what's been filled in here by the recipient, is June 30th, 2020, because obviously their fiscal year is July 1st to June 30th, right? Okay, so that's what they are providing as their most recent information. And they didn't, nevertheless, date that form, but presumably they would have been sending it prior, if they wanted to be on time, they would be sending it prior to May 6, 2021. The fax cover sheet, though, says the date is June 22nd, 2020,
That's
the year before, correct?
Yeah. So it can't be.
So I'd like to take over when the questioning's done, Mr. Chairman, because I was trying to piece this together myself.
Yeah, okay.
You're sending it in a year in advance.
My second question is, the name of the contact is Ken Lee. Is that the owner? Do you know?
I can
Mr.
answer that.
Cole?
Yes, it is. Yeah.
That is the owner.
Yes.
Okay. And has he been the person who responded in previous years?
Previous years I can't answer, but certainly this one he was. So, Mr. Chairman, if I could,
yeah,
because I am a bit lost as well. But what I'm going on is the word of the owner. So if I could try and piece together what I have in evidence here.
Mm-hmm.
If you don't mind going to my direct evidence, I have in evidence the 2019 mailer, which would have been provided in June 20th, 2020.
Just a second. We need to get there.
Okay.
Page 32.
Correct, yeah. So this comes right from the city's online storage of the mailers.
Just a
And as I
second.
mentioned, yeah,
Hang on.
sure.
I'm not there yet.
Okay,
You're saying what page?
page 32 in our direct evidence.
All right.
So when we access the City of Winnipeg's site for the owners with the owner's password, they'll have an income expense summary of the years that they complied. And this owner complies every single year except 2020. And so I put in evidence to 2019, the best evidence of, what I'm trying to get to the value that I had in possession. You'll notice the cover page, June 22nd, 2020. That would have been when he submitted the form. You'll notice the form itself is different than the form that is in my rebuttal. It is the form due date June 18th, 2020, but pertaining to the 2019 year, and he has different figures on here. So when I asked 2 days ago, Mr. Lee, I said, Mr. Lee, the city's seeking a penalty, and I see that you didn't seem to comply with the 2020. And to be honest with you, Mr. Chairman, when it seems pretty cut and dry, I usually just say, you did not meet the compliance, and therefore there will be a penalty. I don't usually have anything to argue. But he said, no, I did. I provided it. I said, well, they don't have evidence of that. He said, well, I fax it. I said, can you send me that fax? And he sent it to me almost instantly. So, which meant to me that this was he had it in his records. Now, it's hole punched, which means he has it in some sort of binder. It definitely is the 2021 mailer. That's what it states right on the form. Like, this is the 2020 form, and he's filled it out. Did he fill it out on time is the question, and get it back to the city? He says he did. I don't have evidence of that, though, because he gave me the cover page. You can see is the cover page from 2019. Did he, because he was trying to fill this out in time, just take the last cover page that he had on file and put that in the on the fax as the cover? I know I've done that. I don't know. But I guess what I'm left with is imperfect evidence of his compliance, except for the fact that, number one, he's telling me he did. Number two, he complied every single other year. I would ask the board to take that into consideration before granting what is going to likely be a fairly sizable penalty.
Ms. Davidson, do you have any further questions in order to seek greater clarity here?
No, I have no further questions.
Mr. Danjal?
I am a little bit miffed in one sense that the evidence on one side shows a pencil written with no signature, and then the other evidence indicating that it's been signed. I'm really torn to come.
Sorry, which two documents are you suggesting that one is in pencil?
So the other evidence there that you're showing there that I'm sorry, where's the pencil one?
In his brief, in the rebuttal brief.
Yeah, so to be clear, the evidence in my brief is the 2019 mailer. As I mentioned, that's all we had in possession, so we put it in because I will be going through that when I talk about the income of the property. And so that's a different form, and it's actually, that is the 2019 form. The point that I'm making is when Mr. Lee sent me the 2020 form saying we complied, I looked at it and said, no, Mr. Lee, I was going to say, this is your previous year, because the date on it is from 2020 on the cover page. But then I looked closer and I realized, no, this is the 2020 mailer, because you can see the due date is May 6, 2021. So they are two different forms.
Yes.
The one in my direct is 19, and this one that he sent me saying he complied with is 2020.
Mr. Danjal, do you have any further questions?
No, I don't. I'm just trying to sort it out in my head a little bit here.
Well, let me just attempt to summarize.
Yeah.
We appear to clearly have two different INEs filled in. However, we have one common fax cover sheet that has the same date on it, and it is a date that was not what the city was looking for in 2021. It says 2020 on it. Is that correct?
That appears to be the case, Mr. Chairman, yes.
All right. Okay, well, in that case, we will take a short recess. We will consider whether the non-co-op penalty will be applied.
Can I just summarize just one point? I want to make something critically clear. Regardless of what happened with the first submission, we sent a second submission certified. They received it. They signed for it. They did not respond to it.
Yeah, but Mr. Pohl, if the owner is correct that he did submit the form by fax and the city, for whatever reason, didn't.
We sent another one dated on another date.
I could see, I would do the same. I wouldn't respond to the second one.
So again, regardless if you feel they responded adequately enough to the first one, we sent a second one by certified mail, which they did not respond. Okay, thank you.
All right, we'll take a short recess.
Thank you.
Oh, you only got till 3, where'd you park?
No, free, like,
Oh, no, but you only got till 3. You
no,
might-
to 3, I think they said 3:30.
Are you parked on a street where you?
No,
can't
no, I'm
pass?
parked in a
Okay.
in park or
Good.
hang tag lot.
There you go.
I'm good to 3:25.
Yeah, that makes sense. So just making sure.
Oh, yeah, because this is
Yeah, they're not taking-
around
even
here,
past
I'm not
3.
going to get any
I won't be there at 3:15.
leeway.
Hey, we're live.
Okay, we will resume following our recess in which we deliberated on whether
The other
the
guy's
penalty
Last
should.
not here.
It's missing.
It's not here.
Oh, he's not
Yeah,
here.
can you hear me?
Yes,
Can you hear me?
Yes, yes.
Here you go.
we can't see you though.
Maybe he doesn't want us to.
Yeah. Oh, it's just, let me try that again. The screen froze on me for some reason. Let me see if this comes up now.
There you go.
There we go.
Okay. All right, we are resuming from our recess in which we deliberated on whether the penalty for failure to cooperate would be applied in this case. And the panel has decided that yes, the penalty will be applied. Therefore, the onus is being shifted to the applicant. So, Mr. Slaughter, could you go first?
Yep. Thank you, Mr. Chairman. Okay, if you could please turn to the Alta submission. Start on page 6. There's a photograph of the property. It was clearly an old bank from originally the 1920s. And there's 14 parking stalls at the side and rear of the building. Now, in 2008, I believe it was, there was an addition put on the rear of the building. That's 2 stories, but 1,000 square feet on each story. And the city's effective age in this case is 1985, which we don't have much contention with.
You're looking at
So
which page? Sorry for the photos. You're on which page?
page 6 and 7 are the exterior photos, but I do have interior photos from the last agent's inspection on pages 17 through 21.
All right.
So fairly basic office finish on main floor and second floor. The basement is just used for storage and it's shared amongst the tenants. There are 3 occupants, 2 tenants, arm's length, and then the owner, Ken Lee himself. The 2 arm's length tenants are on the main floor. They split the main floor each. And Ken Lee, I think, has the rear portion because he has the second floor and part of the main. So in evidence, Mr. Chairman, we have, as I mentioned, the 2019 mailer, which is where I've obtained the information about the rents and then talked to the owner about that. He rents the main floor spaces for $20 a square foot gross. I took the expenses for the property and divided it by the main and upper floor areas, and it equates to $9.23 a square foot. So I then deducted that from the gross rents. Sorry, if you could please turn to page 11. This is where I discuss the rents. So we have gross rents of $20, deducting the expenses of $9.23 imputes a net rent of $10.77 a square foot. And then we looked at the same market rent comparisons. And for this type of property, we felt that the remaining main and upper floor of the property would be applied around $10.50 a square foot. And similar to the other properties, we looked to comparisons for basement space. Although there is no rent collected for the basement, it's included in the rents that the tenants pay already. But we've applied $4 a square foot to the basement space. So on page 13, we have that summary of the 2 arm's length tenants, their net rents from the gross, the owner's area on the main and second. The remaining area that the owner doesn't occupy is just kind of extra storage area, I guess common area he uses for everyone, and then the basement storage that's used by all. We accept the city's vacancy allowance, the shortfall rate we'll accept at 8, even though the actual expenses seem a tiny bit higher. We ask for the non-recovered expense allowance of 7%. And in this case, the city has applied a 6.55% cap rate, which is fairly close to what we're applying to all these properties at 6.75. And so all in all, I thought we'd accept the 6.55. So really the only two contentions, Mr. Chairman, are the market rent and the non-recovered expenses. So on page 15, you see the income valuation, and it totals $804,000. That completes the presentation. Thank you very much.
Mr. Paul?
Yeah, speaking to the purchase, you didn't speak to it, but you'd agree that it was $582,000 purchased in 2007?
It appears that way, yeah.
And then there was an addition put on, as you indicated, in 2008. That is a 2-story addition with no basement underneath, correct?
That's right. It's a 2,100 square feet over 2 floors at the rear of the building.
2,000, okay, that'd be about right. So the basement area would be in any of these pictures here, or are we looking at the newer areas? Like if I'm looking on page 17, this would be in the addition area?
Yeah, I'm not sure, Mr. Pohl, because actually the last agent who inspected the property took these pictures, but it appears that these are main and upper levels, they describe them as. And then the basement on page 20.
Yeah, and okay, just confirming that, because it seems like there's half windows, but if you go around the exterior of the building, there is no half windows for the basement area. So they
No, the basement doesn't appear to have any windows.
Yeah, okay, all right, makes confirming. You know what, that's the only questions I have. Thank you.
Thank you.
Ms. Davidson, questions?
I have no questions. Thank you.
Mr. Danjal?
I don't either. Thank you.
So I'm wondering, Mr. Slaughter, if you can refer us somewhere so we can get a better view of the building, because, you know, when you look at this photo, you'd say, was it just a 1-story building? It'd be kind of nice to see the side. Is that possible?
Yeah, actually, the city has a very good picture in their evidence on page 3.
All right, let's go there.
That's a good point, Mr. Chairman. Usually when I take a Google map photo, I try and get it on a diagonal. But this, for whatever reason, I took a straight line shot.
Mm-hmm. Okay, so the addition is at the back. The main floor, is it full height of that building, despite the fact that the addition actually constitutes 2 floors?
I think it's just main floor. Hang on a second. So the tenants occupy main floor only, and they're a total of 2,400 square feet. And then the owner has 1,500 square feet of the main and second. And then he said the rest is just common area on the upper level. So it sounds like there might be some sort of a mezzanine or something in that old portion.
But you've not valued this with a mezzanine rate for any?
No, I applied the same rate as I applied 1050 to the main and second floor as kind of a blended rent, and I just applied it to everything except the basement.
And for the new addition, where is the access? Do you have to go in that front door in order to go back through the initial building and get to the addition?
It looks like there's doors at the back there, but I can't answer anything further because I haven't actually inspected the property.
Former bank building?
It appears so, yes.
Okay, that's all my questions. Okay, so Mr. Pohl?
Right. So, obviously we have 1,286,000 on our assessed value. If you turn to page 2, if you look on page 2, you can see the brick face of it, all brick obviously, but the less orange brick, the tan brick, you can see the addition put on. That addition has, it looks to appear, an entryway at the first door, and then 2 windows aside from that, so there's an entryway from there. And then if you look on page 3, along the street walk side, it looks like there is again another door there as far as next to the adjacent older building section of it. So it looks like we have 2 entryways on either side getting into the newer section. So there is 3, looks like there's 3 entrances to the building exits. So if you look on my page, and it comes in a little better on the appellant, just so we're clear. On the appellant's page 6, the aerial photo highlights the roof envelope, and you can see this separate and distinct section of the building that was put onto it. So that makes sense where you have a main upper second floor and a main floor, and given the height of the original building, they just made it up pretty close. Looks like almost exactly in line with the roof canopy of the original building. So it really is a main floor throughout with an addition with the second floor addition, with a second floor on the back additions, and then obviously the basement area and the main building. So hopefully that answers your question here. On page 5 and 6 of the same comparisons that we've already used, indicating $15.77, $15.80, and $15 for the total of 68 comparables. We have overall, sorry, I should say, we go to page. Actually, we don't have the income and expense questionnaire. It wasn't submitted. Obviously, we wrote ahead moving on it. That's why it's not included in the brief. As far as the model predicted a $12.70 overall rate, which is on page 7, starting on page 7. A lot of talking today. So for 7,584 square feet, we have an average rent of $12.70 a square foot, which produces a PGI of $96,368. And we have a basement storage C mezzanine area of 24.48, which would be the basement area at a lesser rated $7.11. So the remaining area, main floor and above, are the other rents that you see, which hover between $14.77 to $17.53. So with that, our parameters are same standard parameters apply to the PGI. At 6% for vacancy, expenses at 3% non-recoverable, and $8 for shortfall, which produces a net operating income of $84,220, capped at 6.55%, gives us a $1,286,000. So with that, it's fairly basic workup of all the questions.
Mr. Slaughter?
Thank you, Mr. Chairman. So, Mr. Pohl, again, on pages 5 and 6, you have 68 comparisons, but is there any that you would suggest are good comparisons for the subject property based on its age?
Well, the age itself, you have one, at least almost a half of the building as 2008. So it is a newer building at the back half. And then it obviously had renovations. So, I mean, it's not an older building. The original portion is obviously the envelope in front for the main building. But we're simply looking at the overall marketplace. So when we see a $15 average, 15 to 15.80 or so, where we bracket it at, when we're taking about $3 off of that, I think that's pretty reasonable.
Well, that taking $3 off, to confirm, that's including the basement, right?
Yeah, the basement's in at $7.11. And just so we're clear, we usually agree about $4, $5 or so for space and storage. That's not basement storage. So to put it in at $7 roughly, it's only $2 to $3.
Sorry, what is it if it's not basement storage?
No, what I'm in the basement on your page. Do you not have office space in the basement?
It's storage space in the basement. That's what they're using it for. That's part of the rents of the tenants.
On page 20 to 21,
Correct.
it's finished. Lighted, drywall, carpeted. That's not your typical basement. Right? Am I
No,
looking
but you would
wrong?
agree that there's no separate access, nor is there any windows. Like this could not be leased out to a separate tenant, correct?
No, I'm not saying that demising, no, it's not a demisable CRU, but that is definitely not cage link storage, concrete, exposed ceiling, just plain storage that we agree the $4 to $5 rate typically. That is heated, that is electrified, you can see the drywall in the ceiling. How is that $7 not appropriate for?
Yeah, I think all of the basements that we talked about today have been heated, but it does have slightly better finish than some of the others.
They're using it
But
as
again-
storage, but it's clearly finished is what I'm getting at. You can see it on the so, at $7 rate, I don't think it's inappropriate. And again, these are new to me, obviously. So overall, when we see a $12.70 range, the entire building, I don't think that's inappropriate, right? I think it's pretty accurate, actually.
Yeah, when you say that though, do you have any evidence? We had evidence of rents attained for space with windows accessed separately in the basement. Do you have any evidence to support $7 for this basement space?
No, just generally, like I said, we agree between $4 and $5 for basement storage. And in this case, it's clearly finished. So it used as storage, but it's clearly finished. So I think it's a $7 rent isn't inappropriate to model for that.
Okay, and then when you take out the basement, your rent is, I think it blends to $15.37 for the main and upper space.
Yeah, they're all pretty similar. There's no need for it. And yeah, it's about $50.
Right. Okay, that's all the questions. Thank you.
Ms. Davidson?
I had a question. I can't recall if you mentioned this. Is this owner occupied?
Partially, yes. Again, we didn't have the INE, but it indicated the back what Ron was saying, the back portion of the building, the main floor and upper area.
Oh, yeah, right.
So the newer part is
Yeah.
where he's occupying.
Okay, how long have they been here? Like the AJL and Associates?
I couldn't tell you.
Okay, thank you. That's everything.
Mr. Donjalo?
I have no questions. Thank you.
And I have no questions. Am I missing a rebuttal? Anybody want to rebut?
Nope.
I'm good for the day.
All right. In that case, we have addressed all of the items on our docket today. And consequently, this session of the board revision is adjourned. Thank you for your appearances.
Thank you, everyone.
Thanks very much.
Now,
Thank you.
now we can all go eat some lunch.
Maybe you can
Yeah.
go to kitchen.
Take care.
We'll get in.
Timing is everything, right?
Wow. Like I said, I can't get in there. I can't get downtown.
Well, that's true.
That's